Committee will come to order without objection. The chair is authorized to declare a recess of the committee at any time. Hearing is entitled The Semi-Annual Report of the Bureau of Consumer Financial Protection. I now recognize myself for 3 minutes to give an opening statement. Not that we need a reminder, but if there's one thing that the presidential campaigns of both parties have shown us, it's that the American people are indeed angry, and they have a right to be angry. After 7 years of Obamonomics, they are still suffering through a failed economic recovery, the slowest and worst in our lifetimes. This is indisputable. Americans are even angrier, though, at having their lives increasingly ruled by out-of-touch Washington elites. Every day they see their liberties slipping away as Washington inexorably grows larger, more intrusive, more distant, and more arrogant. As Thomas Jefferson once warned, government agencies are sending, quote, swarms of officers to harass our people and to eat out their substance. Today, the poster child of Jefferson's lament is the CFPB. Its director, our witness, is neither elected nor accountable to the American people. Yet, when it comes to consumer financial products, he is vested with the awesome power of the entire United States Congress. This is amazing, this is frightening, and this is tragic. Soon, Mr. Cordray will presume to decide for all Americans whether he will allow them to take out small dollar loans to keep their utilities from being cut off or to keep their car on the road so they can make it to work. Soon, Mr. Cordray will decide whether he will permit Americans to resolve contract disputes through arbitration or simply hand over the keys to the CFPB's luxury office building to the wealthy, powerful, and politically well-connected trial lawyers' lobby. Already, Mr. Cordray has decided who in America will be able to receive a mortgage under his qualified mortgage rule, which when fully implemented will disqualify almost 1/4 of all Americans who qualified for a home mortgage just a few years ago. Already, Mr. Cordray has decided that countless Americans should pay more for auto loans based upon junk science and a dubious legal theory of statistical unintentional discrimination, all the while his agency reels from countless accusations of actual discrimination. Now, apologists for the Bureau, along with Mr. Cordray, frequently cite the tens of millions of dollars of fines they have imposed as proof that they are indeed protecting consumers. But the Bureau operates as legislature, cop on the beat, prosecutor, judge, and jury all rolled into one. Fines imposed in such an abusive structure tell us nothing about justice. They tell us nothing about consumer welfare, nothing. In short, Congress has made Mr. Cordray a dictator. And when it comes to the well-being and liberty of American consumers, he is not a particularly benevolent one. Congress must address this critical problem because Congress helped create the problem. It has outsourced much of its legislative authority to the executive branch in general and CFPB in particular. And in doing so, has compromised our foundational principles of co-equal branches of government, checks and balances, due process, and justice for all. Congress must reclaim its Article I authority and reclaim it now. There's no better place to start than the CFPB, an agency that has abused its power that it never should have had in the first place. It is time to uphold our oath to the Constitution. It is time to strip the CFPB of its rulemaking authority and return it to the elected representatives of we, the people. I now recognize the ranking member for 5 minutes.
Thank you, Mr. Chairman, and thank you, Director Cordray, for joining us again to discuss the Consumer Financial Protection Bureau's semi-annual report to Congress. The Bureau's accomplishments under your leadership have helped more Americans participate in a financial system that is fair and strong. The work that you do is so important because it means that consumers can access the financial products and services they need to live prosperous lives without the risk of deceptive or abusive practices. It also means that consumers can have recourse when they have been wronged and recoup any finances they may have lost. Those accomplishments are reflected in the $11.2 billion you have returned to 25.5 million Americans. They are reflected in the 830,000 consumer complaints you have handled on issues from debt collection to credit reporting. They are reflected in the increased share of mortgages made to minority borrowers in recent years and the expansion of access to credit cards, despite Republican claims to the contrary. Director Cordray, you are helping consumers succeed to the benefit of the entire financial system. I'd like to highlight a few of these particularly important efforts. I'm encouraged by the Bureau's work so far on payday lending, including soliciting input from small businesses on the forthcoming regulations. We need rules that will protect low-income and minority communities from unreasonable loan terms and unaffordable rates, despite modest efforts by some states to curb predatory practices. Most payday loans are simply used to help pay off another payday loan. We must stop this debt trap, and we must fight any efforts to weaken, roll back, or stop the CFPB's upcoming rule. The Bureau has also led the charge against the discrimination that still exists in the auto lending industry. We should be doing all we can to prevent minority borrowers from being charged higher interest rates and from overpaying on their auto loans. Unfortunately, too many members of Congress have been misled by Republican arguments against the data and methodology used by the CFPB in this important work. While Republicans are attempting to protect lenders, the Bureau has fined banks and captive lenders such as Toyota, Honda, and Fifth Third Bank for discriminatory practices. Additionally, in the month since its last report, the Bureau has successfully won a case against an unscrupulous for-profit college that deceives students into taking out expensive private loans and engaging in illegal debt collection practices. As you know, I've worked on this issue my entire career. Just recently, the Department of Education announced a proposal to ban mandatory arbitration in student lending. I hope the Bureau will follow in their footsteps by offering this protection not only to students, but also to Americans that have found these unfair clauses in their credit cards, prepaid cards, bank accounts, and mobile phone contracts. Despite a successful track record of helping consumers, whether looking to buy a car, own a home, or attend college, Republicans have turned the CFPB into a political punching bag, attempting to undermine its work at every turn. This tactic is at odds with the public's support for the CFPB and the Bureau's efforts to remain accountable and transparent. I'd like to remind my colleagues that the CFPB has now testified 59 times before Congress since it was created, issued more than 40 reports on its activities in the last year alone, and provided tens of thousands of documents in response to a never-ending list of Republican fishing expeditions. Director Cordray, I'm thankful for the work that you are doing. I look forward to hearing your testimony on how the Bureau continues to help consumers and improve our economy. Thank you so much, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of the Financial Institutions Subcommittee, for 2 minutes.
Thank you, Mr. Chairman. Today I want to use this opening statement to address an issue that Director Cordray actually raised himself in speaking before the Consumer Bankers Association conference a couple of weeks ago. In speaking before the group of bankers, the director highlighted the virtues of bringing market-changing enforcement actions instead of going through a transparent and formalized rulemaking process. So some call this practice regulation by enforcement. Further, he critiqued his critics, saying their concerns were misguided. After hearing these comments, I feel it necessary to respond. Businesses of all sizes deserve certainty. From the largest financial institution to the three-office title lender, regulatory risk drives up cost and stunts economic growth. Federal agencies that are authorized to enforce federal law act appropriately when they take actions to hold unlawful actors accountable. However, when the federal agency routinely bring enforcement actions instead of undertaking rulemaking with the sole purpose of changing the entire market behavior, it begins to look like a deliberate evasion of public notice and comment. And public notice and comment is crucial check on the regulatory overreach and abuse of regulatory power. Not only does it allow public to provide unique business insight into the marketplace, but it diversifies and balances the decision-making At the CFPB, this point is all the more important given the agency's current structure, a single unelected individual who can unilaterally authorize an agency action. This celebrated bureau practice is most obvious and concerning in the indirect auto industry market. In the midst of significant public and congressional pushback, the Bureau's policy positions, it chose to strong-arm lenders into changing certain practices through media-driven enforcement headlines. It chose to do this instead of allowing a transparent and process driven by public comment. Some even say that purposely evaded the public dialogue. Unfortunately, this example highlights the very problem with regulation by enforcement. It allows regulators to exert regulatory authority outside a transparent and structured process. It provides an opportunity for regulatory overreach and abuse. Further, it inserts significant regulatory risk into the business of our Main Street job creators. In closing, the director told the Consumer Bankers Association, "When you push back, we welcome your input." The director should expect continued and aggressive congressional pushback to continue his regulation by enforcement.
Time of the gentleman has expired. Today, we welcome the testimony of the Honorable Richard Cordray. Director Cordray has previously testified before our committee, so I believe he needs no further introduction. Director Cordray, without objection, your written statement will be made a part of the record, and you are now recognized to give an oral presentation of your testimony. Thank you.
Thank you, Mr. Chairman, Ranking Member Waters, members of the committee, for the opportunity to testify today about the Consumer Financial Protection Bureau's semi-annual report to Congress. I appreciate our continued dialogue as we work together to strengthen our financial system and ensure that it serves consumers, responsible businesses, and the long-term foundations of the American economy. As we continue to build this new agency, we've made considerable progress on our core responsibilities to exert supervisory oversight over the nation's largest banks and non-bank financial companies, and to enforce the consumer financial laws enacted by the Congress. Our analytical approach to risk-based supervision is leading to more systematic, consumer-friendly changes at these financial institutions, and we're making progress on leveling the playing field for all market participants. During this reporting period, our supervisory actions resulted in financial institutions providing more than $95 million in relief to over 177,000 consumers. Our enforcement actions are based on careful and thorough investigations, and most have identified deceptive practices by the parties involved. During this reporting period, the orders entered on our enforcement actions led to approximately $5.8 billion in total relief for consumers victimized by violations of the law. These consumers are located in every one of your districts nationwide. We're also working to provide tools and information to develop practical skills and help people understand the choices they'll be making to manage the ways and means of their lives. Our Ask CFPB resource provides guidance and responds to inquiries across the entire spectrum of consumer finance. Our major moment-in-time decisional tools now include paying for college, owning a home, and planning for retirement. We've developed a new partnership with the Financial Services Roundtable to work together on financial education in the schools, in the workplace, and on behalf of older Americans, which is proving to be productive. Listening and responding to consumers is central to our mission. We continue to refine the capabilities of our Office of Consumer Response to receive, process, and facilitate responses to consumer complaints, including those referred to us by your offices. We also continue to expand our public consumer complaint database, which updates nightly and is now populated by over 500,000 complaints from consumers about the broad range of consumer financial products and services. We marked a milestone for consumer empowerment when we began to publish consumer complaint narratives, which allow people to share in their own words their experiences in the consumer financial marketplace. Reasonable regulations are essential to protect consumers from harmful practices and ensure that consumer financial markets operate in a fair, transparent, and competitive manner. We focused our efforts on promoting functional markets, such as the all-important mortgage market in particular, where consumers can shop effectively for financial products and services and are not subject to unfair, deceptive, or abusive acts or practices. During this reporting period, we issued several proposed rules, final rules, or requests for information. To support industry compliance with our rules, we've published plain language compliance guides and other resources to aid in their implementation. We're also seeking to streamline, modernize, and harmonize financial regulations that we've inherited from other agencies. Over this reporting period, the Bureau has continued to expand its efforts to support and protect consumers in the financial marketplace. Recent data indicate that sound consumer protections in our major markets are strengthening them for consumers and providers alike. The mortgage market has been expanding briskly for 2 years now, since our major rules took effect. The credit card market is greatly improved with strong consumer protections, better industry performance, and increasing consumer satisfaction. The auto lending market is supporting record sales of cars and trucks to meet consumer demand. The growing sense of consumers that these markets can actually work for them without fear of tricks and traps and other predatory conduct is stoking their confidence and restoring their trust. These developments reflect well on the work being done by the Consumer Bureau, and taken as a whole, they're making substantial contributions to the continued gradual recovery in the American economy. Mr. Chairman, Ranking Member Waters, and members of the committee, thank you again for the opportunity to testify today and to discuss all the work we're doing on behalf of consumers. We will continue to listen closely to all of our stakeholders, and we will attend carefully to your oversight in order to ensure that all Americans can be assured of fair treatment in the consumer financial marketplace. I look forward to your questions.
Chair now recognizes himself for 5 minutes for questions. Director Cordray, as you are well aware, in late 2013, the Bureau entered into a consent order with Ally Financial over alleged violations of the Equal Opportunity Credit Act based upon a legal theory of disparate impact. At the time, Ally had an important yet unrelated application pending before the Federal Reserve to become a financial holding company. On February 21st of this year, Michael Carpenter, former CEO of Ally, said that the charges were, quote, trumped up that your Bureau brought against Ally. He went on to say that Ally had been, quote unquote, strong-armed by the CFPB, and that the CFPB, quote, absolutely knew they had tremendous leverage over us, unquote. Mr. Cordray, isn't it true that you and senior staff in the Office of Fair Lending knew Ally was seeking to achieve financial holding company status prior to the settlement?
So I read the interview with Mr. Carpenter, who of course is no longer
Mr. Cordray,
by Ally.
it's just a simple yes or no question. Were you aware, were you not aware of the pending application prior to the consent order?
We had pursued this investigation against Ally for well over a year before Ally themselves made us aware of their situation.
It's a simple yes or no question. Were you aware, were you not aware?
As I said, we had pursued this investigation for more than a year before Ally brought that to our attention.
Okay, so you were aware. That's the answer to the question. Isn't it true that senior staff in the Office of Fair Lending were in discussions with both the Federal Reserve and the FDIC on how CFPB's determination of an ECOA violation could adversely impact their application? Is that true?
We had no decision-making authority over those other matters. We were simply attempting to conclude our investigation and get to an appropriate result.
No, but the question is, were they in discussion? Was senior staff of the Fair Lending Division of the CFPB in discussion with both the Federal Reserve and the FDIC regarding this application?
I believe there were some consultations about them wanting to know if we were
Okay, so
completing this
consultation, you
investigation.
say consultation, we say discussion. Can we pull up slide number 6, please? I believe on October 7th, 2013, a decision memorandum was prepared for you. I'm not sure you saw this, but it has the operative phrase, staff is in a dialogue with both the Federal Reserve Board and the FDIC. It begs the question, what does this have to do with a potential violation of EOCA? Now, I'm also led to believe, did you receive this memo, Mr. Cordray, do you know?
I do not know.
Okay, go to the next slide, please. What is also interesting is that the last sentence of the previous menu of the previous slide was deleted. And instead, we have somebody with the initials of PAF, perhaps Patrice Ficklin, saying, let's refrain from this discussion and instead quote from the securities filing, which seems to mean that either senior staff attempted to cover up these discussions or they tried to withhold this information from you. Did senior staff try to withhold this information from you prior to the determination?
No, I don't believe so, and I think you've got the entire matter exactly backwards, Mr. Chairman.
Okay, well, regardless of whether you saw this October 7th memorandum, you certainly saw the one on October 17th. I believe these are your initials, decision memorandum for the director. And in it, it says, this could have a material adverse effect on Ally's business, results of operations, and financial position. And seemingly, you initialed this. Are you at least familiar with this report?
Again, I think you've got this matter exactly backwards.
That's not
I'd
the
be glad
question,
to
Mr.
explain.
Cordray. The question is, did you initial this memorandum? And if so, it would seem to indicate that you knew ahead of time that you had advantage over Ally and you used it.
Again, I think you have this exactly backwards. I'd be glad to explain.
Okay, well, Mr. Cordray, you will have ample opportunity within this hearing, but I wanted to know
Should we
whether
do
or
it
not
now?
you saw this memo. So I have another question. In determining the racial characteristics of borrowers in auto lending context, you don't actually have the racial characteristics that you know for a fact. Instead, the Bureau uses Bayesian improved surname geocoding. Is that correct?
We use the same approach that's used in employment
Okay, do
discrimination.
you use Bayesian
generally.
improved surname geocoding or not?
We do the same
Okay,
approach that's used in employment discrimination cases
Okay,
across
so
this
it's
field of
Bayesian
the law.
improved surname geocoding. Okay, we have the names and salaries of the Bureau's employees in our possession, and our committee has used a public search tool to match home addresses and match names using your own Bayesian improved surname geocoding. What we have discovered is that you pay black employees almost $16,000 less than their white counterparts, which would suggest that either one, you are presiding over a racist organization, and if you are not, Mr. Cordray, should not the same disparate impact analysis you apply to others be applied to you? And if you don't believe our analysis, I would assume you actually know the racial characteristics of your employees. I invite you to do your own analysis. But should disparate impact analysis be applied to the CFPB?
I have no idea what analysis you're referring to or how carefully it was done. Disparate impact analysis applies throughout this field of law. It was upheld by the U.S. Supreme Court last June in an important decision. And if you're going to do that analysis, you would need to correct for pay bands and different jobs. I have no idea whether you did that or not, so I would not.
Well, Mr. Cordray, I'd invite you to do your own analysis, and I must admit the evidence is fairly overwhelming. I'm not sure there was any justice taking place here, and I fear what we are seeing are shakedowns for headlines, and this has got to stop. The chair is way beyond his time, and I recognize the ranking member.
Thank you very much, Mr. Chairman. Mr. Cordray, I do not want you to be intimidated or to be made to feel bad by these accusations that are being made by the chairman. I would like to think that the chairman and the opposite side of the aisle are truly interested in discrimination. There's nothing in their work or their history that shows they are. And so you continue to do your work and make sure that the work that you do on disparate impact analysis is work that will benefit all of the people who are being harmed by it. And so let's get on with the real issues. Let's talk about payday lending. Despite the fact there is substantial support for payday operations on the opposite side of the aisle, we know that these operations have targeted minority communities and poor communities, and people are getting hooked on these payday loans. And I want to talk about, for a minute, what is happening here in Florida. But before I do that, I've asked my staff to get me more information about where they're locating and how many are locating, in what areas they're locating. We do know this, as it has been said by the Federal Reserve in St. Louis, there are more payday loan operations than there are McDonald's stores. So a number of states like Florida and Ohio have attempted to reform payday lending, but even after so-called reforms, loopholes and other gaps remain, still leaving vulnerable borrowers susceptible to exorbitant interest rates and cycles of debt. For example, even after Florida's reforms, Floridians still take out an average about 9 loans a year, according to the Center for for responsible lending with an annual interest rate of about 312%. According to ProPublica, investigation into Florida auto lenders who expanded dramatically after Florida's so-called reforms, one Florida consumer appeared to have renewed her loan 17 times in 1.5 years. Another woman borrowed $3,100 and made $2,600 in payments, and after rolling her loan over 7 times, she still owed $3,900. I can give more examples of this, but what I'm giving examples of is how poor people get hooked on payday loans. The fact that these borrowers have to take out multiple loans shows that the loans are not affordable. They are trapped borrowers into a cycle of debt. Tell me why you are issuing guidance on payday loans. What have you discovered about them and how they work?
So what we've discovered, and this is through careful and comprehensive research into the payday lending industry, is that the description you just provided is substantially correct and accurate. About half of payday loans in the United States today are made to borrowers who are trapped in a cycle of 10 or more loans. That is about half of the loans being made nationwide. That's what we found in our research that looked into millions of such transactions. And it's difficult to see how that assists a consumer in improving their financial well-being. Now, there are plenty of payday borrowers who get in and get out with 1 or 2 or 3 loans, and that's perfectly great, and we are not attempting to cut off any such lending. But it is the debt trap, being stuck in the debt cycle, living your life off of these massive rates of interest and difficult collection practices and like that we've seen, that creates a tremendous amount of consumer harm.
According to the work that you have done, the research have you done, is this a profitable industry? Are they making money? Are they making large sums of money? What's keeping them going?
It's actually a difficult product economically. There's high costs involved in defaults. There's high costs involved in customer acquisition. So there are not supernormal profits being made in that area. But what keeps them going, what is at the heart of the business model for the average payday lender, is rolling the customer into loan after loan after loan so that eventually you've recovered more in fees than they borrowed in the first place. And your example was an apt one of someone who takes out a loan, pays back more in the end than they borrowed to begin with, and still owes in the end more than they borrowed to begin with. That's a very normal part of this business.
This is why they are referred to as debt traps.
Yes.
People get trapped. They can't get out. They keep rolling them over. Is that what this is all about?
Yeah. Industry has objected to that notion, but it is the best description I've seen of what actually happens in the marketplace.
Thank you. I yield back.
Chair now recognizes the gentleman from Texas, Mr. Nagelbauer, Chairman of the Financial Institutions Subcommittee, for 5 minutes.
Director Cordray, this committee spent a considerable amount of time studying the short-term, small-dollar marketplace, and most recently, your deputy director testified at my subcommittee on this issue. I will say this, that many of my colleagues did not walk away with much confidence in the direction that you're headed in the rulemaking, particularly on the issue of state and tribal sovereignty. At issue are roughly 38 states who allow these products to be offered in some form, and the federal preemption that will occur if your rule goes forward as outlined by the Bureau. I have a few questions, and I'll use some slides during that questioning, and I hope that you will be brief and forthright in your answers. Slide number 1, please. So after reviewing the current regulatory framework, did you find any state that does not have the authority to enact and regulate short-term, small-dollar loans?
So what I would say is states have authority in this area, and the federal government has authority in this area as well.
So you didn't find anybody that didn't have the authority, so the states have the authority to regulate that. Is that your answer?
Again, as is true in many areas of the law, securities law, antitrust law, telecommunications law, states have authority, and the federal government also has authority.
So slide 2, please. And so can you list the states then that have laws in place that have contributed to the problem that you have identified, and which states have failed to protect their citizens?
So what I can say is, as you indicated, is approximately 37 or so states nationwide that allow some form of payday lending with different degrees of regulation. And our study that analyzed millions of such transactions nationwide showed that repeatedly in this business across the country, many consumers fall into the debt trap. More than half of the loans are made to people who take out 10 or more loans in a row.
So which states then are allowing the debt trap?
That would be all of the areas, all of the states that were examined in the study.
So do you have a list of those states?
It would be all the areas where payday lending is authorized in this country.
So you looked at every state?
We've looked at millions of transactions nationwide that occurred in all of the states.
So in your rule, you talk about, and you've mentioned that there's a floor. So does a floor mean that anything below that standard is void?
So first of all, again, we don't have a rule at this point. We have an initial framework, and we're working toward a proposal. So it's all in process, and this kind of input is relevant to our process.
I think Mr. Super...
But as with our mortgage servicing rules, which are final, we did not preempt state law there. We did provide a federal policy judgment about mortgage servicing practices and indicated, in line with the statute that Congress enacted that gives us authority in the area, that our rules would be a floor for consumer protection, not a ceiling.
So is your position, you do not think that you're preempting state law?
We are not preempting state law. Typically, the federal government, when it's active in an area, could seek to occupy the field. That would be broad preemption. We're not doing that. They could also seek to preempt state law in specific respects. We're not doing that. Whatever we do in this area will coexist with state law. There will continue to be state regulation of payday lending. There will now be federal regulation as well. That's true of many areas of law: telecommunications law, energy law, environmental law.
I understand,
states and the federal government work
that's
together.
your position, but you know the Attorney General, Mr. Zoller, disagrees with you.
I'm sorry, say that again?
Mr. Zoller disagrees with you.
Well, I know the Indiana Attorney General. We served together. I was a bordering state Attorney General of his in Ohio. We have both been interested and concerned about issues of federal preemption going back to our time in state government. And for myself, I spent 20 years in state government.
So if one state has a 5-day cooling off period and the rule comes out that you require a 60-day cooling off period, so haven't you then preempted the state that says 5 days is an appropriate cooling off period and you say 60 is, isn't that preempting that state?
Again, a common aspect of federalism in our system is that there may be federal regulation and there may be state regulation of individuals, and they coexist.
What is your definition of preemption then?
Preemption is when the federal government overrides state law and invalidates state law.
So if my state has a 5-day cooling off period and you say that 60 is the new norm, then haven't you preempted my state?
You could say the same thing about securities law. States have securities laws that protect people who are investing. And the federal government has securities laws as well. And they coexist. They don't necessarily jibe in every particular, but they coexist, and they're regulated at both levels.
Here's the question. These 37 states have gone out there, they've had hearings, they've had debates on the floors, they've passed these laws. What do you know that they don't know?
You could say the same about any of these areas of law. The Telecommunications Act Congress passed in 1996. States had regulated that area for years, and the federal government had authority. Congress gave it authority, and they acted, and then those regimes coexisted.
I'm sorry, Mr. Chairman, but one last. So if you brought those attorney generals of these states and the various groups from those states, have you brought them in to have a discussion about this?
I talk to them all the time. Those are my former colleagues.
Have you had a forum where they had an opportunity to comment?
I have spoken to them at National Association of Attorney General meetings. I speak to them individually. I've had a chance to speak to Attorney General Zeller since he testified in your committee. We talk all the time. We coordinate on many things, including enforcement actions against payday lenders.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of the Capital Markets Subcommittee.
Welcome, Mr. Cordray. Welcome. And my question concerns the Credit Card Bill of Rights, which was the second bill that President Obama signed into law. And Rahm Emanuel, his former chief of staff, told me that it's one of the most popular things that he ever did because it touches so many consumers. And in that Card Act, we required you, the Bureau, to conduct a review every 2 years of whether the act was having the effects that we intended. First of all, I want to know, what is the response to the Card Act? When you get complaints, are you getting complaints about credit cards to the extent you were before the Card Act went into effect? And what about the clear and transparent disclosures? Has that worked? And no more hidden fees or expected interest rate hikes that are hidden? The bill wanted to crack down on unfair and abusive tactics by card companies on consumers. And your report found that the Card Act has dramatically improved the credit card market, making it fair, more transparent, and even as the cost and availability have improved. I for one, think it's useful to have this type of regular review of a major bill. And my question is, are there lessons that you've learned from your 2 Card Act reports that have been useful to the Bureau in writing other rules, and have you used those lessons going forward? Also, 2 celebrated reviews, one by the Pew Foundation, said that the Card Act saved consumers $10 billion a year. The NYU review with others said it was anywhere from $16 to $20 billion a year. And have you conducted any reviews similar to what they have done to see whether it is as good a stimulus package? It's actually a stimulus package that President Obama signed into law because it keeps the money in the consumer's hands. So your comments, please, on the Card Act and those various aids.
Sure. And as you say, we have had a chance to review the credit card market, and we do that now on a biannual basis to report to Congress. And I would congratulate the Congress. The Congress did an excellent piece of work in passing the Card Act, and it has made an enormous difference for consumers. Different assessments of amounts that consumers have been saved in terms of previously exploitative fees range from $16 billion to whatever, but it's important to recognize this is going forward year by year, and every year consumers are saving. Wow. So that's quite important. The second piece is this shows, and by the way, my experience here goes back to when I was in state government before the Card Act was passed, and we would hear tremendous complaints and concerns about the credit card product at that time. And I'm now in the federal government since the Card Act was passed, and we are doing a regular review of this and watching the J.D. Power consumer surveys, which show increasing customer satisfaction in this marketplace year in and year out. It's a tremendous success story, and it shows what can be done with serious, substantive, even-handed regulation, better performance by the industry, which there is, and I give them credit for that, especially on their customer service in the credit card industry, and better consumer performance. People are being more careful with cards coming out of the financial crisis. So that's important, and it shows that if we work together in a balanced and reasonable way, we can improve these markets so that consumers can get more value from them, and that's what we all should want.
Okay. Also in your report, you highlighted the so-called deferred interest promotions,
Yep.
and I quote, impose significant costs on many consumers, end quote. And I think that's really, really important. And my question is, what, if anything, should be done to address the risks the Bureau has identified in deferred interest promotions? And also your comments on the overdraft. You know, we have also a bill that I offered on overdraft that
Yep.
builds on the credit card Bill of Rights. Your comments on where we stand on that rulemaking.
Yes, so we did indicate we have significant concerns about deferred interest products. The reason is the core principle of the Card Act was back-end pricing, which is never transparent to the consumer up front by definition. And it's confusing and harmful to consumers because they think they're making a deal and they're having certain terms, and it turns out it's going to be different. It's going to be changed after the fact in a way that was not disclosed to them. That's very harmful. Deferred interest operates much in that same fashion. So that's something we spotlighted in our most recent report, and it's an issue that we're looking at very carefully, and we're going to be taking actions as appropriate. And I think that credit card issuers should be mindful of thinking about their deferred interest products and the harm that's happening to a number of consumers who end up with back-end pricing that is very different from what was represented to them up front. So that's an ongoing concern.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of the Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. I appreciate it. And Director Cordray, I got to tell you, I'm a little surprised, a little stunned. You just have laid out a case where you are intentionally trying to create conflict between state law and federal law. Now, a number of my colleagues over on the other side have been working on a slightly different issue that I'm sure you're familiar with, medical marijuana law not lining up with federal law and how that has affected banking. And usually there's an understanding that we're going to try and solve that problem, not create the conflict. And I just couldn't let that pass as my colleague from Texas was asking you about the lending.
Do you want me to respond to that or not?
Very briefly, sure.
Okay.
Why would you want to create additional conflict?
I spent years in state government, in the state legislature, as state attorney general, as a state treasurer. It was very common across many fields of law for us to be administering and enforcing state law in conjunction with concomitant administration of federal law. Happens all the time.
I did that as well, but
happens
you
with
don't.
securities law.
But you don't have, and what we typically have, for example, in environmental law, is you have preemptive state law that goes in. First, it has to clear that hurdle. I served in the state legislature as well.
Yep.
So, but that's not the direction I want to continue to ask. I want to pursue a little bit about the arbitration agreements, and I know that was brought up earlier. In March of 2015, the Bureau released a report on the use of arbitration agreements and disputes between consumers and financial product providers. However, the report was criticized by a number of academics and industry for completely ignoring major pieces of data. On June 17 of 2015, over 80 members of Congress, including me, signed a letter asking you that the Bureau reopen the arbitration study, citing issues with the methods on which the study was conducted, including the processes that developed that study that were not, quote, fair, transparent, or comprehensive. And I'd like to submit the letter for the record without objection, Mr. Chair.
Without objection.
The letter also noted the lengthy historical precedent in favor of arbitral dispute resolution, which assists in streamlining the American judicial system. One of the complaints that I hear all the time is we're bogged down in court. Arbitration was a tool introduced to streamline that, not to eliminate anybody's rights, not to eliminate a fair hearing, but purely to start to break the logjam. Because I'm very curious. I mean, do you really believe that this report reflects accurately how consumers use these tools?
So if I may, our report has been widely recognized as the single most comprehensive and informative report on this issue ever done. Had access to new data from the American Arbitration Association and others, and it is an outstanding report. I have seen and we have attended closely to criticism of that report. It's been mostly incidental. We actually sat down with the authors of the one critical study. One of them agreed to sit down with us and talk it through.
Right.
The other did not. But we have
Okay, so
looked at all
I've got
of
a
that.
question specifically. Where does the study estimate the transaction costs associated with the consumers pursuing a claim in federal court versus arbitration?
So what we looked at was how the judicial process compared to the arbitration process in terms of outcomes and the like. And what we found, by the way, was, as a matter of history, what you say is somewhat correct in terms of arbitration started off as a business-to-business dispute resolution mechanism, and it is reasonable in
That's
that
also
context.
individuals.
But it's in more recent times, it's been used to cut off access to justice
so
by
does
consumers.
the study compare ability of consumers to pursue a claim without a lawyer in federal court versus arbitration?
The study comprehensively addresses many aspects of the judicial process, many aspects of the arbitration process, and compares outcomes between the two.
So for those watching on C-SPAN and the rest, the answer to both of those questions is no.
No, my answer is to describe what our study did, and it's the most comprehensive study ever done. Nobody disputes
I understand it's
that.
comprehensive, but there's a number of people involved in that space that believe that there was major flaws in the data and how it was used, and it seems to me that the report's
And we've looked at what they've had to
methodology is
say, and it's not particularly credible, frankly.
So you would have no problem then asking or heeding the request that over 80 members of Congress in the House and the Senate had of saying, okay, we'd like to open this up and express some of our concerns in this.
I'm simply going to continue to enforce the law. Congress asked us to do a broad, comprehensive study. We spent 3 years on it. We're now moving ahead with Congress's direction to engage in policy intervention based on that report.
What I need to know is how you can make a meaningful comparison between class actions and arbitration in this report. I don't see that. and many others in the space do not see that. And that ultimately is the concern that I have, is somebody receiving a check for 25 cents as being part of a class action suit, which often happens as these major class action suits go on. The trial lawyers and the attorneys are all paid up. They're the ones that make the money. It's not the consumers. And I would argue that arbitration actually benefits the consumer as much as it benefits anybody else in that process, because it's streamlined. So it sounds like to me that you're just trying to protect the
But that's
trial
not what our report showed, and it's a comprehensive study of this. Virtually no relief to consumers in the arbitration process, billions of dollars of relief to consumers in the judicial process. That's the comparison.
Time of the
as long
gentleman.
as their attorneys are paid.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Mr. Cordray, we have seen some indication from the CFPB that the lines between what is consumer lending and what is commercial lending are blurred. Can you explain your views on how the agency distinguishes between consumer lending and commercial lending? Are there circumstances in which a loan to a small business could be a consumer loan? And if so, can you elaborate on the nature of those circumstances?
Sure. There are areas where the line between commercial lending and consumer lending is blurry. For example, a lot of startup small businesses are being financed by individuals by putting debt on their credit cards. So that's why the Card Act becomes so important, because it actually protects not just individuals, but also many fledgling small businesses. It's also the case that home equity loans are often used to get capital to start businesses or improve businesses or grow businesses. You know, if I had my way, I don't have my way on many things, we would do what I did when I was Ohio Attorney General and seek to protect not only individual consumers, as their statute authorizes us to do, but also small businesses, who often operate in the marketplace with no greater clout than an individual household does. If the Congress sees fit to give us that authority, we will aggressively pursue that. And it would help small businesses across the country. As it is, again, as you say, the protections that we put in place for consumers often will end up helping certain individual small businesses that start out as individuals or a very small number of individuals and seek to grow.
Well, Mr. Cordray, one area where I'm concerned is regarding online lending. This is an increasingly popular choice for small businesses to quickly access capital, yet the regulatory environment has yet to catch up. What role do you see the CFPB playing in the small business online lending marketplace?
So we are very interested in financial innovation and so-called fintech. We've had the major marketplace lenders in to talk with us because we do have jurisdiction over them. The Treasury has convened both a set of actors and is working on a white paper in this subject. It's something I think we're all interested in because it is a new source of capital for small businesses, but needs to be subject to certain oversight and protections as well. So that's something we'll continue to work on. I think we have, I'm hearing from you a great deal of interest in this area.
Correct.
Others have a great deal of interest as well.
Thank you for answering my letter.
Yeah, okay.
Thank you. Dr. Cordray, to date, 5 attorney generals have issued consumer alerts about deceptive advertising practices by rooftop solar companies, and a handful of settlements were reached in Arizona last year alone. Is the CFPB presently working with various state regulatory bodies, interviewing complainants, and investigating the depth of the problem we're hearing about?
So I can't speak to specific enforcement activity being engaged in by the Bureau, but across the country, when there is the consumers complaining about harm done to them or perceived mistreatment in the marketplace, that's the kind of thing that gets identified to us through our consumer complaint line, and those are things we prioritize for investigation and potential action. I think I can say that much.
Thank you. In May 2015, the CFPB issued a bulletin providing guidance to help lenders avoid discriminating against applicants participating in the Section 8 Housing Choice Voucher Home Ownership Program. Can you explain this bulletin and how it will help increase access to credit for eligible consumers?
Yeah, I'm not sure if this is a direct answer to your question, but under the Equal Credit Opportunity Act, it is illegal for lenders to discriminate against potential borrowers based on the fact that they're receiving public assistance income. That is good income and is supposed to be part of the calculation. We've had several actions now where we found that lenders were not taking appropriate account of that kind of income, and they've made corrective actions accordingly. In general, this is our approach is to the Equal Credit Opportunity Act is one of the statutes that both we and the Justice Department administer, and we will do that faithfully and vigorously to make sure people are being protected and that prohibited classes are not being discriminated against under that statute.
Thank you.
Gentlelady yield back. Gentlelady yields back. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, Chairman of the Capital Markets Subcommittee.
Thank you, Mr. Chairman. I'm just coming in. I'm over in budget right now. But I just want to follow up on the issue of arbitration. So Congress passed a bill. It was signed into law, and the President signed it, which validated the use of arbitration. My understanding now is a study was done.
I'm sorry, what law is that?
The Federal Arbitration Act.
Okay, 1929 or so, yeah.
Yep. Are you familiar with that law?
Beg your pardon?
Are you familiar with it?
I am.
Is that still the law of the land?
It is still the law of the land,
Because
yes.
you disparage it by saying 1920.
No, I'm just saying, in 2010,
Yeah.
Congress passed the Dodd-Frank Act and made a number of changes in terms of how arbitration would be handled, including outlawing arbitration clauses in residential mortgage contracts, most residential mortgage
Federal Arbitration Act, which allows for arbitration, is still the law of the land.
although it's
Is
been
that-
modified
is that-
by Congress in several respects since then, yes.
And it is now your agency's decision to, what, upend that law through a comprehensive action?
No. So Congress has now intervened and superseded the Federal Arbitration Act in specific respects. Under the Military Lending Act,
Has Congress ended the ability for arbitration?
so
Is
in the
that a
military,
yes or- that's a yes or no question.
in several respects, yes, they have.
They have ended, I didn't say in several respects.
Yes,
I said,
in several
have
respects they have.
ended the use of arbitration?
Under the Military Lending Act, they barred arbitration clauses in lending contracts to
so we
service
can't seem
members.
to get-
Under Dodd-Frank, they barred it
you
in
did
residential mortgage contracts for the most part.
Have we
They
have we
spec-
totally eliminated arbitration?
No, but they
Oh,
then,
okay.
but
Thank
they
you.
gave us then authority. Congress conferred
And
on us.
so
I'm not
is it
making
your
it up.
intention now
address
to
these issues.
eliminate arbitration?
Because Congress specifically said, and we merely carry out the will of Congress, Congress said that we should issue a report, do a study, issue a report, and then act in terms of addressing arbitration
So
in
when
light
you
of
say
that
that
study
it's
and
your
report.
intention to perform the will of Congress, when 80 members of Congress write to you and ask for a specific question, do you believe that you should answer those questions, yes or no?
I pay close attention to what members of Congress tell me. It's my job to enforce the law that Congress has enacted.
When 80 members of Congress ask you a question, do you believe that you have the responsibility to respond and answer those questions?
I respond to individual member of Congress, but I enforce the laws that Congress enacts.
So the answer is no, since you did not say that
No,
it's
that's
your
not correct.
responsibility.
The answer is yes.
You do. Well, we sent a letter back on June 17th of last year. We're still waiting for a complete answer. It says the Bureau, with regard to that so-called comprehensive study, the Bureau ignored requests to disclose the topics that would be covered by the study. Have you disclosed all topics that have been covered by the study? That's a yes or no.
So I'm not sure what all back and forth in correspondence there has been. I know we responded to that letter. If you think that response was insufficient, we'd be happy to work with you further and
The
get
Bureau
you more
also
information.
failed to provide the general public with any meaningful opportunities to provide input for the topic because the materials were kept behind closed door. The final arbitration study included entire sections that were not included in the preliminary report that was provided to the public. Was there a reason why you decided that certain information would be held confidential and not disclosed to the public?
Some of the information, depending on how we obtain it from the American Arbitration Association, others businesses have deemed confidential, may involve trade secret information and the like. Those would be the obstacles.
And are those-
Wouldn't
are
be any desire on my part.
Are those the only sections that are precluded from being public, the trade secrets, or is it a broad swath of areas?
Yeah, I'd be glad to have my staff, who are expert in this area, deal with your staff and speak
Obviously,
specifically to
since we're
specific
talking
pieces of the
about a
report.
letter from June, and here we are in March, we're still looking for a complete answer.
We have
to it.
responded to the letter, and if that response was deemed insufficient, we'd be glad to work with you further to get you more information.
Well, it goes back, I guess, to your initial answer to the question, is whether you feel that it's your responsibility to answer to 80 members of Congress. You know, when you were first came to this committee, I asked you, I guess, the seminal question. If the House of Representatives said you shouldn't do something, are you accountable to them? And the response was no. And I said, if the Senate said that you should be doing something, should you respond to them and respond? Your answer was no. I said, if the President asked whether or not that you should be doing something, the answer was no.
I don't remember any of this
final
discussion.
answer was,
certainly don't remember it in that way.
yeah,
No.
that was my series of questions. The final question was,
No.
are you accountable to anyone? And the answer to this letter and that question back then
No,
was
that's
no.
not what I'm saying, and that's not a legitimate, characterization of this.
Well, actually, that's-
I
actually,
respond
that's
to
on-
members
actually,
of
that's on the
Congress.
record.
But I have a responsibility to enforce laws enacted by Congress,
And the
not
law,
by individual
the law of
members of Congress.
1929 has been enacted by Congress, and it would appear that you are
And so
going
has the law of
contravention that
2010.
law.
Yes.
Time of the gentleman has expired. The chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. Good morning, Mr. Cordray. It's Director Cordray. Great to see you this morning. And let me first join many of my colleagues I know on the Democratic side. I think it should be on both sides, because we all should be thanking you for all the work that you've been doing to help the American consumer, for the work that you've been doing to help our veterans, to help our students, to help our mortgagees, and especially for the work that you do for low-income and minority communities that are always the most victimized. It's those that are on the bottom, and the work that you're doing to try to make sure that there is a level playing field. And I would think that, given the scenario, both sides of the aisle should be appreciative of the agency and the work it does. I see there's room that we can work collectively together. For example, what's important is that since the financial crisis, a number of financial services have closed. There's been over 5,000 branches of closures, especially in most of them in low income and communities of color, leaving behind banking deserts, which are neighborhoods with basically no mainstream financial services. But the people in those neighborhoods cannot live without access to financial services, and therefore, to meet those great needs, there are alternative products, such as short-term lenders, and I hear my colleagues talking about that, and prepaid card providers, et cetera, of which, I just think about my parents. I was in poor, lived in public housing, went to a bank. At that time, some banks, they were not bankable, but they needed to have options, so they used other options. Back then, some of the options are dark. We don't want folks to go to the dark. So it would seem to me where your agency is a godsend to me is not to wipe out all of those businesses, but to try to make sure that we regulate them so that there is a good practice, so that people are not being ripped off, so that there is a strong and functioning alternative financial services so they're not being denied access to financial products also, as they would have. So, sometimes I knew my dad needed an extra, few dollars to make it to the next month, till the next paycheck came. And we need that kind of service, but we don't want it where people are caught in that forever. And I think that would be good for both sides. Nobody should want that. We don't want anybody taking advantage of it. And so if we have an agency like yours that can then put in some rules and some regulations so that we can make sure that the consumers are not getting ripped off, but also, and I think that would be good for those who are providing good services.
Yes.
They would want that also, because we want to get rid of the bad folks. We don't want to get rid of everybody. We want to get rid of the bad folks. That would seem to me would be the goal. And so I think that is the right approach that we should take, and I think that that's the approach that you're trying to take in this, not just eliminating an entire, but eliminating the bad guys, and let's make sure that we uplift the good so that poor folks and low-income areas will have some opportunities to continue to bank. Is that correct?
So I found myself sitting here thinking that you're saying a lot of things that I try to say when I'm sitting here in this seat testifying, and I think you may have just said it better. So I would just agree with you.
So now, let me just give, in the little time I have left, what I was concerned I saw about the Bureau's latest enforcement and findings, because I'm shocked here we are in 2016, and there's still redlining going on. and they're redlining, especially in the mortgage lending and the steering of consumers in high-cost loans. It amazes me that we're still finding institutions thriving from this egregious practices. So can you please discuss with us in the little time I have left what is going on in those cases and what the Bureau has done to address it?
So we've seen a lot of things over the last few years, and frankly, again, 90% or more of our enforcement actions involve deceptive conduct by financial institutions, which is discouraging in some ways. But even we were somewhat surprised to see what we thought was very blatant redlining occurring. This is the enforcement action that we and the Justice Department jointly took involving Hudson City Savings Bank. And the patterns, when they were mapped, were very clear. And so it's a significant resolution and a shot across the bow to the entire marketplace that this is not acceptable behavior, it is not acceptable approach, and people doing and correct it if, in fact, they've gone down that road in any respect.
I only have 7 seconds, so I yield back.
Gentleman yields back. Chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, Chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Mr. Cordray, you and I, over here, you and I have had a number of discussions with regards to TRID, and certainly appreciate your willingness to discuss it with us. As we've seen, you've delayed the implementation of the rule until October, and since then we've seen a lot of concern by the industry. They're struggling with this rule. Some of the software programs that they've utilized have not been as good in implementing this as they would have liked to have seen, and they're still struggling. So my question is, what do you see from your position as the enforcer of this, as well as have you had any enforcement actions taken against anyone at this point?
Yeah. So I think we see and hear much the same things that you're describing. I think the IT problems here have been much larger than maybe people would have expected, and particularly because a mortgage lender can't control the IT systems of realtors or title agents or settlement agents and others, and they have to all work together. So I know there was a bill in Congress proposing to have a hold harmless period through February 1st of this year. What I had said, and I'd worked with the other regulators to jointly say, was we were going to be corrective and diagnostic, not punitive, as we oversaw this implementation period, and it was open-ended. It remains open-ended. We're now March 6th, midway through March today, and it remains open-ended. We have taken no enforcement actions. I don't expect us to take enforcement actions unless somebody is blatantly just failing to try to implement the new rule. And to the extent that they are making some mistakes but trying to get it right, we're attempting to provide more clarification to them, which is something industry is asking us for, and also recognizing nobody is really trying to exploit consumers here. This is just a matter of getting these forms right and getting them correct. And by the way, the whole purpose behind this was something Congress wanted, and it's a positive purpose, which is taking what used to be 2 bureaucratic forms at the application stage and streamlining them into one, and the same at the closing stage, and that's what we have done here.
Okay. Are you going to issue an additional guidance on this, or you feel that everybody's doing okay with what's going on?
No, we will continue. We have been monitoring this very closely. The last thing I want is for any of our rules to cause a jam up in the market beyond anything that anybody would intend. I think we're getting more guidance inquiries every day, but the trade associations are working together to provide some joint questions that they think are most important. We will attempt to be responsive to that, and you feel free to keep after us to make sure we do that.
Oh, we will, trust me.
Okay.
Also, along a different line, the Federal Trade Commission Act grants the the FTC and banking regulators with the power to pursue enforcement actions based on unfair and deceptive acts or practices, UDAP. Dodd-Frank marked an unprecedented expansion of UDAP authorities for the CFPB, including for the first time the term abusive. Expanded series of powers for CFPB, referred to as UDAP, has become a primary enforcement tool. I realize that last week you spoke to the Consumer Bankers Association, rejected the notion that you're regulating by enforcement. I beg to differ, sir, and when it comes to CFPB UDAP authority, you have issued little to no guidance preventing any financial institution from any sort of predictability. You use your UDAP authority on a case-by-case basis. Isn't that the definition of regulation by enforcement?
So we're doing the very same thing there that the Federal Trade Commission does and that the state attorneys general do. It is difficult to know how to do more than case by case when you're talking with cases of fraud or deceptive conduct. But we attempt to give guidance to the entire market by very specific orders that are issued in these cases so that everyone knows that if they're doing this, they should stop. If that's called regulation by enforcement, I think it's just strong deterrence, and it's important as a law and order mechanism for signaling to other actors.
Along that line, the last time you were here, excuse me, I asked the question just before we got finished up with regards to a debt collection company that you wound up settling a situation for $12 million based on a proposed rule. Not a rule that's enforced, but a proposed rule.
I'm sorry, what matter are we talking about?
Well, Encore.
Okay,
You had a
debt collection. Okay,
debt collection, and this was based on not a rule that was enforced, but it was on a proposed rule that you thought you made down the road, have enforced, and said that they had a form that was non-compliant. So is that not regulation by enforcement?
Yeah, I don't think that's what we did in the Encore matter. So in the Encore matter, we did a careful investigation, thorough investigation of the facts. We found that there were violations of the either Federal Debt Collection Practices Act or of the unfair and deceptive prong that were given by Congress, and we enforced against that. The notion that because we may issue a rule on debt collection several years down the road, or maybe next year, whenever it will be, that in the meantime we can't stop people from engaging in an unfair and deceptive conduct, I just don't think is the right approach for us.
I see my time has expired. I yield back the balance of my time.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Hinojosa.
Thank you. Thank you very much, Chairman Henserling and Ranking Member Waters, for holding this important hearing on the CFPB's semi-annual report. Director Cordray, I want to thank you for your appearance here today and for your exemplary leadership at the Consumer Financial Protection Bureau. Before I proceed with my questions, I wish to voice my strong support for CFPB and its mission of protecting American consumers. Mr. Chairman, Henserling, I ask unanimous consent to enter my opening statement into today's record.
Without objection.
With that, I'll be able to move right into my questions. Director Cordray, many argue that the Bureau issues a payday lending rule in line with the released outline, that if you do that, it will eliminate a crucial source of lending for many low-income people that have no other options. Why does the Bureau see the need to regulate payday lenders, and why do you believe consumers will be better off with CFPB oversight?
So again, we were given authority by Congress to address this marketplace, among others. In fact, it was specifically called out in the Consumer Protection Act of 2010, the Dodd-Frank Act. We have done extensive research. We've assessed and analyzed millions of transactions. And again, what we found was a significant portion of the customer base, half of the total loans being made, payday loans nationwide, go to customers who are in a sequence of 10 or more loans. That is a debt trap. I don't know what else to call it. It creates tremendous harm for consumers. It's the exact point that was being made earlier in the ranking member's example of someone taking out X dollars in loans, ending up repaying more in fees than they ever borrowed in the first place, and still owing more at the end of all that than they borrowed in the first place.
Thank you for your response. I strongly support your efforts to rein in those harmful payday loan practices. In my community, we've seen some programs that cost 1/10 of what payday lenders charge, but there just aren't enough of these programs. Tell me about the 5% option included in the proposed rule, and will it be included in the final rule?
I can't speak to what may be in the final rule. We're just coming up on a proposal stage here. So again, we're going to continue to take input from many different stakeholders, and of course they have very dramatically conflicting input, and that's something we try to sort through. What I can say is that in approaching this rule, we're attempting to both address significant and actual harms to consumers, and we're also trying to make sure that there are ample avenues that remain for small dollar lending to be available to consumers. And you know, community banks, credit unions have a product now that we want to make sure that we are protecting and giving latitude for, and other products that may arise around the country. We don't want to squash innovation in this area. we do want to, as to the extent we can, squash predatory products that are amassing enormous consumer harm.
According to the FDIC, nearly 50 million Americans are either unbanked or underbanked. Consumers sometimes need access to at least $100 or less to smooth the transition between paychecks when their balance is low, so that they can still purchase medicines and groceries and other necessities. How have the QM rules affected mortgage lending by community financial institutions?
So this is important because I often see facts alleged that are not accurate in this area. The share of the market of mortgage lending by community banks and credit unions has grown since Dodd-Frank was enacted. It is larger now. It is larger now than it was in the mid-90s. This has come at the expense of large banks in particular. This is exactly the point that I think Congressman Meeks just made, which is that if you have even-handed, sensible regulation of a market, the more responsible actors should be able to thrive because they're freed from unfair competition by the bottom-feeding, law-violating actors, many of which came into the mortgage market in the middle part of the last decade and engaged in highly irresponsible lending and ended up blowing up the mortgage market. So community banks and credit unions, contrary to much of what is said, their market share has increased, and that's a good thing.
My time has...
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of the Oversight and Investigations Subcommittee.
Thank you, Mr. Chairman. Welcome, Mr. Cordray. As you know, I've expressed some of my frustration with regard to the lack of compliance with the document requests that this committee has made to the CFPB. That's with the backdrop of Barack Obama telling us that this would be the most transparent and open administration ever. That's with Elizabeth Warren indicating that sunshine would flow into the CFPB. That's in regard to the backdrop that you've given with regard to openness and transparency. It gives us great concern that for a number of our subpoenas, they go back several years, and there's been a lack of compliance. As you know, there's been a recent subpoena 3 months ago that have compiled all of our document requests, and we get limited compliance from you. I want to direct your attention.
To that?
In a second.
Okay. Yeah.
You'll have plenty of time. I want to direct your attention. You're aware that a report came out from this committee in regard to indirect auto lending, and you would note that there was some documents that we included, quotes in that report from the Consumer Financial Protection Bureau. Did you provide those documents before this report to this committee?
I can't speak to individual documents. I don't know which ones you're referring to, but what I can say is...
The ones in the report. I'm referring to the...
Over the course of the last several years, in response to numerous requests...
Director Cordray, I'd like you to answer my question. So I'm talking about the report that we did on indirect auto lending, the one that came out on November 24th. I'm sure you read that because you made some calls to the Hill. Did you provide those documents to us?
I can't, out of context here, place individual documents over the last several years. I know that we've been very responsive to your requests. You've gotten tens of thousands of pages of documents, and if there are particular ones that you're looking for,
Director Cordray, I love that you could send me tens of thousands. You could send me tens of millions of documents. If you don't send me the ones that I asked for, just like Hillary Clinton can send thousands of emails, but if you don't send the 10 that are relevant, if you want to talk about recordings in Watergate, you could send hours of recordings, days of recordings, but if you miss a few minutes, it's those that are relevant.
We continue to work with you on those responses. We'll be glad to continue to work with you.
I know that you know what I'm talking about in regard to this report, and you know that you didn't send us these documents. And even after this report came out, we've again asked you for the documentation in this report, and you've refused to comply again with our requests. And that, sir, is incredibly frustrating when, again, you've made commitments to being open and transparent.
We'll continue to be glad to work with you on those, Congressman Duffy.
Mr. Director, we've been trying to work together for years, and I
still am trying to work with you, and we'll continue to try to work.
Working is easy. Give us the documents. Send them to us. Send us what we asked for.
We'll be glad to sit down and talk further. I know our people are talking further.
Well, I want to just kind of highlight some of the, well, before we go there, in the Ally settlement, let's talk specifically about that. You use your proxy data. In regard to your analysis on proxy data, what percentage of accuracy do you have in regard to Ally?
So it depends on, it depends on what you're talking about. There's different degrees of accuracy for different things. We work to provide a high degree of accuracy in terms of potential charges of disparate impact discrimination under the law as
Disparate impact.
reaffirmed by the Supreme Court last
So in
June.
disparate impact, what percentage of accuracy do you have?
Again, it depends
can't
on
tell
what
me?
we're talking about. Are we talking about the
So is
auto
it a-
market, the mortgage market? Are we
We're talking,
talking
I'm sorry, we're talking
this
about
or
auto market.
that? Okay. A high degree of accuracy.
What is a percent?
Well, I can't give you specific percentages, but if you want my staff to work with your staff on
So,
specifics there, we can do that.
It's fair to say that you are not 100% accurate, is that right? Yes,
I don't know
right?
if anybody's ever 100% accurate.
So is it
but,
fair to
we get
say
as
that
close as we can?
there are some white borrowers who may be included in your analysis that'll get checks from the Ally settlement?
So I would say that if you're administering any redress to consumers, and this is across the entire spectrum of what we do, what attorneys general do, what the courts do,
Yes or no?
it is
Is it-
always possible that redress will find its way.
So
to
disparate
different-
impact checks will go to white borrowers potentially. And so, okay, that's fine.
There's
That's-
nothing unique in this area.
Great. So, and in your analysis, I'm sure that you saw some African Americans who paid higher rates than the white average and some African Americans who paid less than the white average. Is that right?
What we saw was systematically African Americans and/or
So are you telling-
Hispanic borrowers in certain matters.
Is it your
were paying
testimony that
more.
nobody paid less than the white average?
Beg your pardon?
Is it your testimony that no one paid under the white average, less than the white average?
I don't know that I would say that, but again,
Okay,
it
so
depends
my
on what
question for
matter
you
we're
is,
talking about and what
Is
data
someone who paid less than the white average, are they also getting a disparate impact check?
Again, I'm not sure what
Yes or no?
matter you're talking about or what data you're talking about, but what I would say is
Director Cordray,
disparate impact discrimination is something I know has been under attack in certain quarters.
Are you familiar?
The Supreme Court
The
reaffirmed
time of the
that
gentleman
as
has
land.
expired.
We're
Pursuant to
enforcing
Clause D4 of Committee Rule 3, the chair recognizes the gentleman from Wisconsin for an additional 5 minutes.
Thank you, Mr. Chairman. We're talking about the Ally settlement. You're well aware of that, right? And I'm talking about the numbers that you use for that settlement. So I'm asking you simple questions. Are white borrowers getting disparate impact money? You're stonewalling me here. You're not answering my question. And I think this is a pretty simple line of questions. If you want to be open and transparent, be it here. If you're not going to give me the documents, answer my questions.
Sure. Okay.
And so that was one that you're trying to waffle on. The next question
I'm
is...
ready to do it.
Hold on. And the next question is, you have individuals who probably, I know this for a fact, paid less than the white average. Do those African American borrowers get disparate impact checks as well? Or are you only sending checks to African Americans who paid more than the white average?
Look, if you want to specify someone to me, we can look at it. What I know is that we set up a process here working with the Justice Department, who has experience in these matters going back decades. And that is a process that everyone has confidence in.
So you haven't
and
sent...
it is getting
I'll
redressed
reclaim
to
my time.
hundreds,
You
hundreds
haven't...
of thousands of consumers.
Director Cordray, you haven't sent me the information on Ally, but we do have the information in regard to Toyota. This comes from a document dated November 19, 2004. It was initialed by you, and on page, I believe it's 15, is a chart that shows non-subvented African Americans, the total number of affected at 116,500. Okay, if you want to look up, do you have the document in front of you?
No, I don't.
Look at the screen, you can see that right there. And the number of harm prohibited basis borrowers is 66,000. So it's my reading of this document that there are 56% of African Americans who paid more than the white average and 44% who paid less. Fair enough in the Toyota study?
I'm not easily able to analyze these numbers.
You signed off on the document.
But you know, go ahead with your question.
Okay, so
you're
if you want to go down to the subvented African Americans, the number that were affected was 7,559, but the number that had prohibited or were harmed was 2,668. So meaning on the subvented class of African Americans, only 35% paid more than the white average. 65% paid less. These are your documents, sir.
Well, so what I would say is...
I want to be clear. If you're not going to give me the Ally documents, we'll use Toyota.
So what I will say is subvented auto loans can behave differently from normal auto loans, and that is something we take account of in our analysis.
That's why I gave them both to you. Look at the chart.
Yeah.
So in this document, you don't show great disparity between African American rates and white rates.
So I would disagree with your conclusions there. We did pursue a matter with Toyota. We thoroughly analyzed the underlying facts. The automaker lender had access to the same underlying facts.
I'm going to reclaim my time. In regard to the analysis that you've done, I find it interesting when the chairman brought up when they did their own statistical analysis on the CFPB, and that would show, based on that analysis, that you pay African Americans $16,000 less than white employees at the CFPB. Before the chairman cut you off, I think you were trying to say, but it doesn't take into account pay bands.
I didn't know if it did or not. I didn't have any of that
job titles,
analysis,
right?
So
You want to make sure that we consider what information you might have that could account for that disparity. And so in regard to indirect auto lending, did you take into account credit scores, trade-ins and trade-in values, whether the car was new or used, the amount financed, the length of the term financed? Because this was all information that the auto lenders tried to get you to consider, but you refused to do it.
No,
but when the role was
wouldn't-
reversed and Mr. Henslin asked you those questions, you wanted to make sure, whoa.
Yeah,
There's
I wouldn't agree with that.
qualifying information
Wouldn't
for
agree
this,
with that
sir.
characterization, but I'd be happy to explain if you want me to.
Well, I won't have you explain it. Maybe we'll do it in writing. Maybe I'll get some documents from you. I want to pull up another exhibit, or actually, I'm not going to put it up. I'm going to hand you a document. This was provided to us in response to our subpoena number 20 and 22. This was the only document that is in compliance with our subpoena, and this is in regard to records memorializing the final remuneration plan in regard to Ally. And do you have that document in front of you?
No, I do not.
I believe you have it. Your staff has it. This is basically a computer printout. If you'd hand it to the director, please. This is a computer printout. This is the only document that you've given us to show us what the remuneration plan is. Could you read this document for the committee so we can understand what this document says in your sunshine and compliance with the committee?
What do you want me to do? You want me to just start down here and read?
Yeah,
the
read-
words
yeah,
on
read
the
it for me.
page? Okay, for official use only? Is that what you would like?
No, I was thinking you might go
Confidential,
to
not for distribution? Is that?
compute space cap equals 900 period backslash star money sign dash cap on full dash term. What does this mean? This doesn't mean anything,
All I know is if
Director.
you ask for documents in an area, we give you the responsive documents that we can.
This is the one that you sent us.
And it may be that you aren't in a position to interpret this document. I don't know about that.
Are you?
I'm not going to
Interpret
read
this
you
document?
documents.
Time of the gentleman
Why don't you
has
interpret it for me?
expired.
What does it
Time of the
mean?
gentleman has expired. Pursuant to the committee's rules for extended questioning, the ranking member is now recognized for an additional 5-minute question period.
Thank you very much, Mr. Chairman. At the beginning of this hearing, we started talking about the CFPB's work and racial discrimination in auto lending, and specifically the CFPB's $98 million settlement with Ally. And I also mentioned in my opening statement that the Bureau has fined banks and captive lenders such as Toyota, Honda, Fifth Third Bank for discriminatory practices. These banks and auto lenders that you have fined, if they don't think that you are correct, if they want to oppose you, if they want to fight you, can they go to court? Can they sue? Can they defend themselves in some way?
Sure, and there are a number of institutions that have required us to take them to court, not responded to the results of investigations, and if so, we pursue it, and the courts have the ability to make that determination.
Did Ally do this?
They could have, but they did not.
They did not. Did Toyota do this?
They could have, but they did not.
Did Honda do this?
They could have, but they did not.
So while they are pretty big companies, they have the right to sue, they have the right to go to court, and even though they have friends on the opposite side of the aisle who would like to serve as their lawyers, they could have gone to court if they had wanted to. Is that right?
Certainly.
Thank you very much. Now let's go further. The Republicans are alleging that the CFPB used Ally's desire to change its status to a bank holding company to leverage the settlement. Isn't it true that the CFPB was investigating racial discrimination at Ally Financial prior to any knowledge of Ally's desire to change its status?
So I'm glad to have the chance to correct the record on that, and some of the members who asked those questions are not present in the hearing room, I understand, but maybe they'll see the transcript. We opened an investigation against Ally into potential discrimination in auto lending more than a year, maybe a year and a half before the matter was resolved. As often happens, parties that are being investigated, it moves slowly. They're not eager to resolve the matter, and sometimes they drag their feet. Sometimes it just takes a while. At one point, Ally wanted to move more quickly to resolve the matter. That was a decision that they made, and that was a choice that they were making for their own reasons. I wasn't familiar with why those were. They then explained to me why they wished to proceed in that fashion. Our purpose all along was to complete and resolve an investigation into discrimination in auto lending. That was our job. That is our job to enforce the law. That is what we did. And we reached an appropriate resolution that the company agreed to and was willing to enter into, and as you say, could have fought in court if they wished to do so. That was up to them. Those were choices they made. Those were not choices I was making. Our choice was we were trying to enforce the law. We were seeking to complete an investigation and resolve a matter, and we did so. That's all there is to it as far as I'm concerned.
Isn't it true that CFPB only consulted with the FDIC and Fed regarding Ally's status after Ally themselves informed the CFPB of their desire to change their status?
I believe that is correct.
Isn't it also true that the CFPB had evidence that Ally Financial's policies surrounding a discretionary dealer markup resulted in widespread racial discrimination?
That is certainly correct.
Can you speak more about your investigation of Ally and how you came to that settlement? I know you just did, but I want you to reiterate because, you know, I think that my colleague on the opposite side of the aisle has framed this in such a way that you have been unfair, that somehow you're not following the law, and that somehow you leveraged their desire to change their status. Would you please go ahead
So I would say quite the opposite. The law of the land, reaffirmed by the Supreme Court last June, is that disparate impact discrimination is against the law. It is a violation of fair lending laws. Given that that is so, our responsibility is to enforce the law. It's a law that Congress enacted. Again, that we have a job to enforce the laws Congress enacted. We approach every investigation in the same way. Some of them start with exams that then lead to developing facts and conclusions that may lead to enforcement actions. Some of them start as enforcement investigations. We approach them all the same way, to comprehensively establish the facts, to determine legal conclusions, to work with the entity to try to resolve the matter, if we can, by consent, if we can't, by litigation. And we work with the Justice Department on these matters. They're our active partner, and we work together on them, and we see eye to eye.
Time of the gentlelady has expired. The chair now recognizes the gentleman from California, Mr. Royce, chairman of the House Foreign Affairs Committee.
Thank you, Mr. Chairman. On the question of exemptive authority, as it applies, Mr. Cordray, as it applies to your ability to exempt community banks and credit unions from rulemakings, you argued in a recent speech that it was not plausible for you to use such authority to override Congress's own judgment on such a broad-based policy matter. And, Director, as you know, Section 1022 of the Dodd-Frank Act gave the CFPB the authority to adopt regulations by allowing it to exempt any class of entity from its rulemakings. Just this week, 329 members of this House wrote to you, it was Mr. Stiver's letter actually, wrote to you to tailor regulations for community banks and credit unions, citing Section 1022 exemptive authority specifically. Do you believe that Section 1022 gives you the ability to tailor regulations for community financial institutions? And does a letter from, this would be over 3/4 of Congress, does such a letter change your view of congressional intent?
So I would say two things. First of all, we have routinely tailored our rules to take account of different circumstances of small lenders as opposed to large lenders. We did that with our mortgage origination rule. We did it with our mortgage servicing rule. We did it with our remittance rule. We will continue to do it where appropriate. Second, I always attempt to be responsive to letters from members of Congress. I was in a more humble station, a member of the state legislature in Ohio, and I have understood the legislative role, and I respect it. I would also say that I think what I think I know here, and I may not know as much as you all do, certainly about the legislative process in the Congress, and I wasn't around for the Dodd-Frank debates, but both of the major credit union trade associations have said publicly that they sought a broad exemption from regulation or oversight of any kind when Dodd-Frank was being debated. In both cases, apparently, it was rejected by the Congress. It was not written into the law. What was written in was differential treatment of banks under 10 billion and credit unions under 10 billion in assets as compared to those above. We have gone beyond that and at times provided special dispensations or special provisions for smaller creditors, often those of 2 billion in assets or below, and we will continue to do that where we find that to be appropriate on the facts. But in terms of a broad overriding of what Congress made a judgment about in that statute, which was not to simply exempt all credit unions from everything having to do with consumer protection, I feel that Congress has spoken on that.
Let me ask you another question. In November 2015, you released your updated rulemaking agenda indicating that you expect to issue a final rule on prepaid cards in the spring of 2016, and I would ask if that's still accurate.
I think that is still roughly accurate. I would comment that the spring starts, as I understand it, next week and will extend till the third week in June or so.
In proposing its rule governing prepaid cards, was it the Bureau's intent to prohibit issuers from offering overdraft protection to card users? If customers want and like overdraft protection for their prepaid card, is it the Bureau's position that they should still be denied the opportunity to choose such a feature?
So in the proposal for the rule, that is not what we did. We could have done that. We could have sought to ban overdraft. There were a number of stakeholders who suggested that to us and actually urged us to do so. We opted for more of a middle ground, which was that overdraft could be provided on prepaid products, but if so, it should be subject to the same Regulation Z approach as is used with credit cards, which is an accepted approach that's been in place for credit cards for many years, and that's what we proposed. We will be finalizing that rule roughly on the time frame you described, and we continue to consider how to approach that issue, among others. By the way, I would say that one thing that's happened since the last time I testified here on prepaid cards was we did have this significant fiasco with the Rush card, where many thousands of consumers had prepaid money onto these cards and could not get access to the money. If anything, that shows me we need strong consumer protections for prepaid cards for which none exist today.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Clay, ranking member of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank you, Director Cordray, for attending today. Just to expand on my friend's inquiry from California, can you give us a sampling of what CFPB rules are expected to be finalized this year?
This year?
Yeah.
You know, it's hard for me to hazard a guess on what exactly will be finalized when, because the process, it's kind of like a judicial opinion. It's under advisement, and it just gets done when it gets done. I think we clearly expect to finalize our prepaid rules this year. I think we clearly expect to finalize further amendments to the mortgage servicing rules this year. I think we are underway on a number of other rulemakings, and I just couldn't really hazard a productive guess at this point as to exactly when those will be completed.
I see. Thank you for that. And switching subjects, it has recently come to my attention that some of my constituents are offered loans by lenders that are not licensed to operate in Missouri. My understanding is that a customer will click on the online ad of a lead generator, with the customer doing so under the assumption that they are dealing with a licensed entity. But instead, their information may be sold to an unlicensed tribal or offshore lender. In March 2015, Missouri Attorney General Chris Koster shut down 8 online payday lenders that were operating illegally and whose illegal lending practices impacted more than 6,000 Missouri residents. In one instance, a Missouri resident was charged a $500 origination fee on a $1,000 loan, which was immediately rolled into the principal of the loan, where she was then charged a 194% annual percentage rate, eventually paying $4,000
Yep.
for a $1,000 loan. Can you share insight on what?
Yeah, look, I've heard some horrific stories from the state of Missouri on lending that is occurring at interest rates effectively 1,950% annualized. And I read this in a court opinion from a Missouri Court of Appeals case in which they gave some examples from the record. What I would also say is that Attorney General Koster, with whom I served when I was Attorney General of Ohio, is absolutely right here. Anybody who seeks to make loans without being licensed in a state is violating state law. We believe that if they attempt to collect on those loans under federal law, they may be violating the Federal Debt Collection Practices Act, and we have, and federal unfair and deceptive practices. We have open matters on that in the courts, and I think that that's all quite appropriate.
And so you have it. Missouri has caught your attention as far as the abuses are concerned of consumers.
Very definitely.
Thank you for that. You know, as it relates to estimating the racial or ethnic impact of auto discrimination, to your knowledge, do any statistical methodologies exist that eliminate all false positives and false negatives?
I'm not a social scientist, but it seems to me unlikely that in any field of social science or natural sciences that that's easily possible. But I wouldn't claim to be an expert.
Okay, if Republicans have concerns about using estimates for race or ethnicity, shouldn't Congress just tell auto finance companies to start collecting this data as HMDA does for mortgages? Wouldn't that eliminate the need for estimation?
Actually, it would. Yes, I believe so.
Okay, are proxy methodologies used in other civil rights enforcement contexts?
Have been for decades.
And they have been for decades?
Yep.
Well, I appreciate your response, and Mr. Chairman, I yield back.
Thank you.
Gentleman yields back. Chair now recognizes the gentleman from New Mexico, Mr. Pierce.
Thank you, Mr. Chairman. Don't want to catch off balance, Mr. Cordray, but I would like to thank, over here, I'd like to thank you for the past couple of years. Your staff's been working with the coalition to save seller financing, basically streamlining the rules under Title 14 of Dodd-Frank just pertains to the seller financing. That's something that you and I had discussed in one of our meetings. And
yes. So
I appreciate whatever's going on there. There's some sense that we'll come to resolution there. So at what level do you think that people who are using payday loans are trapped? In other words, how many loans in a row does it constitute that?
I don't know if there's a hard and fast definition, but I guess from what we have seen, if half of the loans being made in that marketplace, more than half of the loans being made in that marketplace are going to people for whom this is marketed as a short-term 14-day loan, and in fact, more than half the loans are going to people who have rolled them 10 or more times. I mean, it seems like that crossed the line somewhere along the way.
That's kind of not the direction I'm going, but I appreciate that input. Do you have a figure at the problem payday loans about how much the people owe when they get to be problems? In other words, if somebody owes $100, is that a problem, or does it need to get to 1,000 or 10,000?
I'm sorry, talking about tribal payday loans in particular?
Yeah, payday loans. I mean, that's something you all really have concentrated.
I wouldn't have a specific figure to put on that. I just
Is there a
wouldn't know what to say
figure
about that.
at which you identify people having payday loans that they're kind of in trouble?
I think
How much if they owe
many
20?
people have looked at that and have different points of view, but I would say the overwhelming consensus of a lot of people who look at it is that rolling loans in long sequences where you end up paying more in fees than you borrowed in the first place, and you still owe at the end more than you
say
borrowed in the first place.
With all respect, sir, you tell me that many people have many different ideas. You're the top regulator in the dadgum country. I'm asking you, what is your opinion? And you can't give me an answer. So
well, you all sometimes have a high
with.
opinion of my authority. We are working through these issues. We've issued a very significant
you're
report.
going after an industry and trying to shut them down. I mean, we may disagree. There are people in my district who use them and regularly and say, hey, if it weren't for that, I wouldn't have been able to pay my rent this month. But forget that. Let's go to exploitation. You've talked about exploitation today. I write the notes down as you're talking.
Yeah.
So at what level are fees exploitative?
So let me correct the record on one thing. We are not seeking to shut an industry down.
You're doing a pretty
We're
good job
seeking
of
to
it.
restrict
Please, sir,
certain predatory practices that are unfair or deceptive.
Limited in time. I would like to move on, and I think your actions speak louder than your words by far. But at what level is exploitation a problem? In other words, is 5% per month, would that be an exploitative fee?
I don't have a particular comment on that. I think.
But you made comments that you're trying to stop exploitation. So how do you determine if it's exploitation?
Okay. Well, again, I would say, and I think most reasonable people would agree, that if you are offering a loan that you know more than half of the loans will involve rolling the loan over 10 times, paying more in fees than you borrowed in the first place, and owing more at the end than you borrowed in the first place, that gets a lot of consumers into a lot of trouble.
I mean, we've already discussed that multiple times today, and I appreciate it. I was hoping to have a substantive conversation. I don't think that's probably going to happen. I'm sorry about that. So the 5% per month fee comes straight from the IRS webpage. You're going to pay 5% per month when you're late. And that, to me, I think crosses into the exploitation category. And so you and I have discussed this before, and I'll just ask you once more for the record, do you ever deal with exploitation on the part of the U.S. government?
We don't have authority to address.
Okay, all right, fine. That's fine.
Or state governments.
That's fine. Do you have any authority over student loans? Because student loans charge 5%, where the Wall Street bankers pay less than 0.5% to get money in student loans. You pay 5% on those. Do you deal with student loans?
Look, I think there are various issues that might be looked at there, and maybe they're for the Congress.
Yeah, so there are various issues that you haven't looked at. You're looking at other issues. So if I would wrap the whole thing up in the direction I was going, you established a QM rule, and the QM rule was supposed to protect consumers. But what it actually did was drive 95% of the loans into the GSEs, which are exempt according to the legislation that you try to impact.
No,
so
I don't think
95% are driven into the GSEs, and you have no action that you're taking on GSEs. You're coming down here picking on the people who are making loans to people just trying to pay the rent on the end of the month. But when you drive them inside a government, then your answer is here, we cannot do anything to back the government off. We don't deal with the IRS. We don't deal with the government loans. And what you do is you're driving people into a market where you don't care if they're being exploited or not. And so I just think that's an important...
I don't see that as the actual fact.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you very much, Mr. Chairman. Over here, Mr. Carteret. First of all, Mr. Carteret, it's very important for you, for the CFPB, for this nation to know that there are Democrats on this side of the aisle that have serious, serious concerns and issues about how you're dealing and going forward with this racial situation at the CFPB. We have legitimate concerns, and I have expressed those. But here is the most dramatic fact with the auto dealers, and that is this: your methodology. Now, fair is fair. And when you start talking about discrimination, and you start talking about giving people checks because they've been discriminated against, but then you use a methodology that is flawed, totally, based upon the last names of people. So now what we have, and you know this for a fact, you have many white people out here whose last names are Johnson or Williams or Robinson or Smith or Scott or whatever, who are getting checks. And they're standing there at the mailbox wondering, wow, where did I get this check from? That is an unintended consequence that needs to be corrected. Yet, you ignore that glaring fact and continue that process. The other area is this. If an African-American customer goes into a dealer and he tells that dealer that, Mr. Dealer, I can only afford a $350 a month payment for an automobile. And that dealer looks at that and he decides that he will go in and cut his own retail margin into the deal and lower that discount rate to meet the demands of that African American's budget. And yet your rule, your situation, would deny that dealer, would deny that African American customer who the bank won't deal with, many of whom don't even have a credit card. There's 60 million unbanked, underbanked people in this country, and a huge percentage of them are African Americans. When you discriminate, that is discrimination against African Americans when your rule and your action denies them access to that car. How are they going to get to a job? These are the unintended consequences. This is a legitimate business reason for the allow the dealer to come in there and either meet or beat that. These dealers are in communities where they know families, in the rural areas especially. Those car dealers are everywhere in a community, and they have relationships. Why deny this African American the opportunity because he doesn't have that budget? And here's the other point. The Department of Justice, which is indeed the legal and lawful arm of jurisdiction under which the dealers come, not you. You deal with the financial end, the lenders. Mm-hmm. But the unintended consequence of this is you're strangling the poor dealer and you're denying the very customers that you're supposedly trying to put this in view of to try to help. And then much of the money that you are getting out there for this is going to white people. Now, that is as plain as the nose on our face. And we need protection from abuses. But this entanglement improperly was reflected with the overwhelming support of the Congress. And it wasn't just Republicans. 92 Democrats also stood up because of this basic reason. So my point is that when you are willing and open to look at the whole picture, not just this narrow aspect, but I guess my time is up, but I hope you understand the reason that both Democrats and Republicans This is an issue of soaring magnitude.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Posey.
Thank you, Mr. Chairman. Director Caudray, it's no secret that I'm still a little bit apprehensive about the CFPB. You know,
I'm trying to help you get through that.
sometimes I get
Like
the
us.
feeling that despite the great sounding name, Consumer Financial Protection Bureau, that sounds really so wonderful, that it's going to just be another government entity that will be used to punish political enemies and bully law-abiding citizens, like Lois Lerner and the IRS, for example. I like to think that that's the last thing we need, that Congress and other agencies like the IRS already do enough of that. One of the many, many reasons that we don't have time to go into today that make me feel that way is your opposition to my proposed legislation, which would allow businesses and individuals to ask whether a particular transaction complies with your rules. Otherwise, they might be left playing a guessing game as to how the CFPB might act or react to what they are doing or not doing. Do you think it's important for the Bureau to communicate with the companies they regulate?
We do all the time.
Good.
All the time.
Is that a yes?
Yes.
Okay. Do you think it's important that businesses understand the regulations you enforce on them? Yes or no?
We
Just-
try very hard to make that happen, yes.
Okay. Do you think the CFPB has a role in helping companies understand and comply with the regulations that you implement?
I think we've been by far the most active regulator ever in doing that, yes.
Thank you. Do you think consumers fare better when more businesses understand how to comply with your regulations?
Yes, because if otherwise the rules actually don't get implemented, then they aren't worth anything.
Okay. I like to think that you feel the way you said, which is why I was so disappointed with the Bureau's final no action letter policy. I mean, here's an excellent opportunity to provide some clarification to companies and individuals who are faced with a constant stream of new regulations. You know, in my office, I've kept the register for the last 5 years. It's become a little bit of a tourist spot for people to come in and have their pictures taken with the regulations the administration, federal agencies, not elected people, but unelected people, have implemented in the last 5 years. I asked people how high the stack of new regulations is, and the highest number I've had anybody guess so far was 7 feet. The reality is, it's 7 stacks over 7 feet. Yet, it's my understanding that the Bureau is still expecting merely 1 to 3 requests per year, and that the policy you set up is the expectation that there's only going to be 1 to 3 requests per year. Is that correct?
This is a fair line of inquiry, I think. I intend for us to do more than that. We opined that we thought we might get as few as 1 to 3 applications a year. I think we may get more. We also said that we would work to try to accommodate greater demand if there is a greater demand. The purpose, as I had in mind, of having a no-action letter policy, and it took some time and effort to work through that, was to try to capture some of the spirit of the bill that you're talking about in terms of people being able to get their questions answered and have some clear space to go forward. By the way, we also do this on a daily basis. We get questions, we get thousands of questions a year that we do answer.
Reclaiming my time, I'm limited here. I understand that. Have you had any inquiries yet?
I think the policy has just taken effect, and I don't even know whether the effective date has yet passed. So I don't know the answer to that at the moment. We'd be glad to keep your staff informed if that's.
You know, if resources were taken off the table, you know, if money wasn't an issue for the CFPB, which it's not, would you then have any objection to making the no letters policy more expansive?
Actually, money is an issue for us. We have a hard budget cap set by Congress that we have to comply with. So we always have to think about how we're allocating resources to different things, and they bar against each other. We don't have an unlimited budget.
See, the frustration that I see all the time is the only time we're concerned about money is when it really, truly benefits the public.
No, that's
like
not-
communicating with these people and letting them know what to expect.
No, that's not. So we're concerned about money all the time.
We've had your assistant come in here, and I think a member from the other side asked her how much money she made. She refused to tell us. I mean, money never seems to be a problem, except when it's trying to help the public.
It's not true. It's not
Thank
true.
you, Mr.
Money is an
Chairman.
issue
I
for us
yield.
all the time, and helping the public. is
Time
an
of the
issue for us all
gentleman
the time.
has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of the Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman, and I thank the witness for appearing as well. Also, I thank the ranking member. Mr. Cordray, you and I and a good many other people are well aware of what this is all about. There are people who want to emasculate now the CFPB and ultimately eviscerate the CFPB. It's over the airwaves. All sorts of things are being said. There was even an allegation made that I had some concerns with the CFPB to the extent that it was alleged in a sort of a sketchy way that I was supportive of emasculating the CFPB. Not in those words. So that's really what this is all about. There are people who really would like to have a financial protection bureau, not a consumer financial protection bureau. And so all of these things are done to give the CFPB a bad image. I want to go on record as making it very clear I support the CFPB. I support what you're doing to help in the area of auto lending, to help us with payday lending. I support these things. I wish we could do more. I don't believe that all dealerships are engaged in invidious discrimination. I don't think that all payday lenders are bad people, but those that are ought to be properly regulated, and they ought to be penalized for what they do. Let's talk quickly about Ally. It is true that Ally settled that case for about $80 million, I believe. Is that correct?
And they've paid out more since to remediate further problems year by year.
And it is true that Ally was prepared in the sense that they had their litigation contingency ready to do battle in court, which is the American way. That's why we have an independent judiciary. But they were prepared, they were in court, and they chose to settle the lawsuit, correct?
I assume so.
Okay. With them settling this lawsuit, I assume that they thought this was in their best interest to do so. But what I marvel at is how these major businesses can lose in court but come to Congress to win, because that's really what this is all about. They want to now change the rules of the game so that they can continue to perpetrate these kinds of invidious acts upon people who need the money they have, are barely making it, and still find themselves being discriminated against and having money taken out of their pockets. Everybody, it seems, wants to fight discrimination until they have to fight it. And then when they get to the point of having to do something about discrimination, invidious discrimination, I might add, that's when none of the tools seem to work for them. Using testing doesn't work for them, which is probably one of the best ways to determine whether invidious discrimination takes place, because you can send people out, and those that come back with empirical evidence can share that with you, show that they were discriminated against. Then disparate impact, another tool, just doesn't seem to work for them. Any tool that we design doesn't work for them. Everybody wants to fight invidious discrimination until they have to fight it or find a way to do it, unless it's at the CFPB. If it's at the CFPB, then all sorts of specious allegations are made, attempts to do everything that they possibly can to besmirch the CFPB, because they've already said, and I admire them for being honest, that if ever they get a president, they're going to do things to eviscerate, they don't use that terminology, but that's what's meant, to eviscerate the CFPB. It'll be taken away from us. I'm reminded of what Ben Franklin said when he came out of Constitution Hall, and someone queried what type of government, a monarch or a monarchy or a republic. And he said, a republic, if you can keep it, We have a CFPB if we can keep it. I'm not sure we're going to be able to keep it, to be quite candid with you. I'm going to fight on my watch, but I know that there are many watches to come. And just as the same people who are against the CFPB, the same people who want to do something about Social Security, they want to privatize it, all of this, in my opinion, goes back to something the Supreme Court did in Citizens United versus FEC. The Supreme Court said that money talks. Well, money is talking right now. Right now, today, money talks. These big corporations now know that they have an edge because they can do whatever they want and challenge us if we challenge them. It makes a difference in the lives of little people, people who are not as big like the corporations. And we got to do something about it, and I thank God for what you're doing.
Time of the gentleman has expired. The chair now recognizes the gentleman from Ohio, Mr. Stivers.
Thank you, Mr. Chairman. I appreciate you being here. I'd like to welcome you before the committee, Mr. Cordray. Most people don't know it in the room, but Mr. Cordray is my constituent, so it's always good to have a constituent in the room. And you probably, I know you answered the question to Mr. Royce from California earlier, sent you a letter with 329 members of Congress who signed it bipartisan, a massive majority of the members of Congress. And Mr. Royce asked you a little bit about it, but he left a little bit out, and I just wanted to follow up a little bit.
Okay.
So did you read the letter by any chance? It's about
I don't think it's come to me yet.
Okay,
I think
good.
it
Well, I
came
hope
over
you read it.
yesterday, and I have not seen it yet.
Nope. I know you're a busy man. I hope you read it soon. So the bottom line is the General Accounting Office.
I read all the letters. I just haven't gotten that one yet.
No, I understand.
So,
I understand.
okay.
The General Accounting Office did a study, and they found the number of cases where community financial institutions, both small credit unions and small banks, had to discontinue or limit access to services as a result of your regulations. And you have the authority under Section 1022 of Dodd-Frank to modify your regulations and sort of adapt them to the people that they're applied to. So I would urge you to do that. And I'm a very visual person, so I have a visual display for you. And Jesse's going to hand you a T-shirt. Could you hold up that T-shirt and take a look at it real quick? And maybe comment, is it a nice T-shirt? Is it well designed?
I'm not an expert on T-shirts, although I do wear it.
It looks like a nice T-shirt. Could you hold it up a second, please?
Excuse me.
Just I want. So okay. So could you try to put it on? What sizes have you looked at?
I kind of dressed in my normal uniform today, and I'm kind of reluctant to deviate.
Does it look like a big T-shirt or a small T-shirt?
Looks to me like a small T-shirt.
It's a small T-shirt. That is a size 2T T-shirt. Compliments of Sam Stivers.
2T?
2T. Compliments of my son. 2T.
What's that mean?
It means he's a toddler.
Okay, got it.
And so it means you wouldn't fit in it. So the two ways you could fit in that are go on a massive diet and restrict yourself, which is what a lot of our community financial institutions are doing to make themselves smaller to serve their clients less, or they could strain the T-shirt and break the T-shirt, T-shirt being the regulation. That's the problem you're putting folks in. So I'd ask you to take a look.
Could I have a moment?
At 10, you can in a second. I'll give you time. Take a look at your authority. You talked earlier about your authority. You took your authority seriously in another realm when you were talking to one of my colleagues that said, we take our authority very seriously. Take your authority under 1022 seriously, too. So what are you going to do about that? And I'll give you about 20 or 30 seconds to tell me what you're going to do to help these folks under, and you admitted you haven't read it, so you probably can't tell me what you're going to do, but I guess I will ask you, are you going to read it and take this seriously? Could you answer that question?
Sure, but let me also talk about the facts here, because, for example, CUNA, they have economists on staff that actually present facts in reports, and then they also write certain opinion pieces that don't jibe with the facts. Credit union membership last year, in the wake of 4 years of the CFPB, is at a new all-time high in the nation. That's good news, I think, but it's not consistent with this notion that we're killing credit unions. Credit union share of the mortgage lending market, where supposedly our rules are stifling them and driving them out of business, is at its highest level than it has been for the last 20 years of keeping track. They're doing better in a marketplace that rewards responsible lenders, all right? It is also the case that we have contoured our rules in ways that give advantages or give differential treatment to smaller lenders, whether community banks or credit unions, because that's consistent with the data coming out of the crisis that they had lower defaults than other lenders. They should be able to continue their relationship lending model, and our rules have provided specifically for that. We will continue to think about those things on a case-by-case basis. But this argument that everybody's being driven out of business, they're stopping products, they can't fit into a 2T toddler T-shirt, isn't consistent with the HMDA data, which shows that total mortgage lenders, numbers of mortgage lenders were up last year, that credit union membership is at all-time highs, and that credit union mortgage lending in particular has increased its share of the market at the expense of large banks.
And I've given
so
you a
let's
little
deal
time,
with the facts.
and I'd like to reclaim my time and tell you the problem is the number of small credit unions is going down because your regulations are making it difficult for small credit unions. They're having to merge, and I had it happen in my district. 3 credit unions merged into one bigger credit union because of the regulatory burden. We're seeing it all over this country, the same thing with small banks, and the regulatory climate is speeding it up. It's not the only cause, but it's speeding it up.
Congressman,
and
it's been
please
happening
use
since
your
the
authority.
1920s. Since the
Use your
1920s. There's
authority
nothing
to
specific
make
about
it
Dodd-Frank that is changing.
Time
It's
of the
been happening
gentleman
since
has
the
expired. The
1920s.
chair now recognizes the gentlelady from Ohio, Ms. Beatty.
Thank you, Mr. Chairman and Ranking Member, and thank you, Mr. Cordray, for being here today. There are some benefits in being last. You get to hear all of the information, good or bad.
I notice you actually sit through the entire hearing.
I do.
Yeah.
First, let me just say how proud I am that you are from Ohio, and certainly I associate myself with all of the words that have saluted you for protecting those folks we need to protect, which is in your charge. Let me also say that we've not talked about the billions of dollars that you and your agency have been able to recover for those who have been wrongly defrauded. Now, a lot of controversial issues here today, and I've been a part of some of it. But what is amazing to me, being a black woman, is how we talk about protecting consumers, and we pick and choose when we want to use the words disparity and discrimination. And sometimes, for me, it has seemed very political, that people are using it, whether it's you, whether it's President Obama, whether it's anybody that is helping those folks who look more like me. I've looked on websites pages of some of my congressional folks here, and it's all about destroying you, it's all about racism, but we only seem to do it when we're protecting those folks. Now, here's what I think, and I'm trying to look at both sides. So if we take one of the most controversial votes that, for me, and I'm all with you, I'm supportive, but here's my issue. I think we've wasted a lot of time in here. A lot of time arguing without resolve. And I was always taught if you complain, you should have resolve. So if we take the House bill that came up, that we had black dealers who were against it, we had dealers who, let's say, were more majority, but there were some minority in there that was supportive of it. But here's a wonderful document. And I think we all have it, Mr. Chairman. I'd like to enter into the records because it's about what you do.
Without objection.
And it talks about fair credit compliances. All three. You can take the black folks, you can take the white folks, you can take the combination. They all signed off on this document. So then we get this legislation that we're all in a tiff about. And the legislation really doesn't resolve the problem. So whether you're for it or against it, it doesn't make any sense. Because here's the issue that I'm going to allow you the last half of my time left to answer. When I think about those African Americans and minorities who walk into a dealership, do I think some of them are discriminated against? Yes. I think some of the people who walk in this room that look like me are discriminated against because of all the stereotypes that we all know about, and unfortunately we've heard in this room. Now, on the other side, do I think somebody walks in a dealership that looks like me and is not discriminated against, or they don't automatically get a higher rate? Well, what's the difference? It might just be that I was more aware, had a better credit score. Nobody's talking about the real systemic issues and the problems. And it starts with, because we can't change the color that you go in, but we need to make sure that we put practices and things in place that's beyond names and zip codes. But here's the other thing. If we start together on financial literacy, the 7th state in this United States, you have done more than any single person on financial literacy in that state. So my question is, we create Dodd-Frank, and I'm all for Dodd-Frank. I wasn't here. There is a part of the Dodd-Frank legislation that talks about real financial literacy. And we're not doing enough in this committee that's charged with looking at the banking industries, looking at the financial industries, looking at the credit union industries, but we're not talking about a program. Even from the minority dealers in their letter to me, it said we're not dealing with the real issue of the transparency of the people's credit, and we're not coming up with any legislation. So Dodd-Frank mandates that the CFPB's Office of Financial Education shall, not maybe think about it, shall develop and implement a strategy to improve financial literacies of consumers. Okay? It doesn't say consumers who go into a candy store, so that means a consumer that goes into an automotive dealership. They have to have financial counseling. They have to have information to assist with the evaluation of a credit product. Let's say that product is a car, and the understanding of credit histories and scores. Lastly, I had a member, an African-American person, to tell me that they got that high interest rate, and thank God they did, because they could go to work, they could have a car, and they could feed their family. And I'm sorry I don't have enough time for you to answer. But
time of the gentlelady, rather,
Thank
has
you.
expired. The
Madam
chair now.
President, to enter into the record the letter from the National Association of Minority Automobile Dealers.
Without objection, and members are reminded, all are allowed under general leave. The chair now
The
recognizes the
National
member.
Association of Minority Automobile Dealers
chair now
is not in support of
recognizes-
H.R. 1737.
The chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Thank you, Mr. Cordray. I'm over here. I want to follow up on some of the discussions that Mr. Nagelbauer from Texas had with you about the interplay between federal regulation and state regulation. I think Mr. Nagelbauer was asking you specifically about some of your proposed rules on short-term, what people call payday lending, and how it interacts with state action in the same field. During your questioning, and I seriously, but despite what you may think, in this particular circumstance, I'm not trying to put words in your mouth. But I think Mr. Nagelbauer...
I always take your comments at face value and listen closely.
Mr. Nagelbauer asked you which states had failed to protect consumers, and I think in a back and forth you said all 37 who have failed to, I think, do something, all 37 that still allow payday lending or that haven't banned payday lending. So I'll ask the question again and see if we can get a clean answer. In your research, as you prepared to produce these new rules on short-term lending, which states have you determined have failed to protect their own consumers?
So again, maybe I wasn't clear in trying to respond to the question before. That's not how we approach the issue. It's not my job to control states or tell state officials what to do.
Great.
It
Let's
is my
stop
job.
right there. That's fine. Let's take that and go down a different road then.
But it is my job to look at what kind of harm is occurring in the marketplace and potentially look at ways to intervene to address certain predatory practices of lenders.
All right. Is it fair to assume then that if you promulgate a rule that is more protective of consumers than a state has made, that you deem that state to not to be adequately protecting consumers?
So we will not seek to occupy the field and exert preemption in that manner. I think it wouldn't be consistent with the Dodd-Frank Act. What we will do is, if there's a federal policy intervention, and again, this is not yet determined at this point, that will coexist with state regulations and authority, just as it does in other fields of law.
You do. Let's be clear and be honest. You do intend to preempt state law in certain areas.
No, I don't think we intend to preempt state law. I think that what will happen is...
I'm just using your words, Mr. Cordray. Your letter of February 11, 2016 to my office. I asked you about this particular issue, and you said, among the Bureau's goals is to ensure that consumers are offered certain minimum protections no matter where they are located or whether they receive their loans from storefront or online lenders. State laws that afford consumers greater protection would not be preempted by a Bureau regulation on small dollar lending. The obvious implication to anybody who speaks the English language is that states that offer consumers less protection will be preempted. It's your language.
I don't know. Maybe you're drawing that conclusion. What I would say is, as is true in securities law, as is true in antitrust law, I work with these laws as State Attorney General.
The SEC
State
comes
and
in
federal
here,
law
the SEC gets money
coexist.
from us. The SEC has an entirely different oversight. Y'all are different. You don't get appropriations from us. You don't have the same level of oversight. You are your own thing. So you cannot compare yourself to the SEC. Let me ask you this.
I wasn't comparing.
Your home state has acted in this area. Your home state, I think the last time they looked at short-term lending was in 2009. They've done it over the course of the last 10 or 15 years. They have not provided a cooling off period between transactions. Your proposal will require 60 days. I will ask you, sir, who knows better how to protect consumers in the state of Ohio, the people of Ohio or the CFPB?
Well, what I would say is, policymakers, as I was, for the state of Ohio, do their best to protect the citizens of Ohio. Policymakers at the federal level who
Have
are
they
given,
failed in this circumstance?
Policymakers at the federal level who are given authority by Congress, as the CFPB has been given authority by Congress, do their best to protect people nationwide.
The last
And
time that
two
Ohio
coexist
addressed this
together.
issue was in 2009. You were the AG in 2009. If you were the AG today in Ohio and the CFPB made a rule that preempted Ohio law, would you defend the Ohio law or would you acquiesce to the federal preemption?
So I have been engaged in issues of preemption going back to when I was Solicitor General in Ohio in 1993-94. And I've addressed them on both sides
Wonderful
of the issues
resume.
over
What's
the
the
years.
answer to my question?
And so it would very much depend on what circumstances we were talking about.
This one.
Okay. Well,
Ohio passes a law. It says there's a 2-day wait period. The CFPB passes a law, says there, or regulation saying there's 60-day. Will you defend Ohio law against federal regulation?
Okay. So look, that's entirely a hypothetical.
No,
We
you
don't
want to be
even have
governor.
a proposal here.
Can you say the word? Can you actually say the words? The people of Ohio know better how to protect consumers in Ohio than the CFPB.
The people of Ohio are also people of the United States. They have a dual capacity.
You
that
can't
is
say those
true of our
words,
system
can you?
of federalism.
Are you capable? Do you believe that statement?
Do I believe what statement?
Do you believe that the people of
Ohio are
Ohio
also people of the
are
United
better
States?
suited to protect consumers in Ohio than is the CFPB? Do you believe that statement to be true?
That's a very general statement, and I don't know what exactly that means exactly.
Fair enough. Thank you.
Yeah.
Time of the gentleman has expired. Chair now recognizes the gentleman from California, Mr. Sherman.
I think the gentleman from South Carolina is misusing the word preempt. To preempt means to prevent the state law from being effective. To supplement means that you have to obey the state law and you have to obey the federal law.
Will the gentleman yield for a brief statement,
I'm
please?
sorry, I only have 5 minutes. If
You
if the chair will yield me additional time, I will yield.
Chair will yield an additional 30 seconds.
I will yield the gentleman 30 seconds.
We had this discussion last time when Mr. Silberman was here. My state has a law that has a 2-day waiting period. They are proposing a regulation that is a 60-day waiting period. And my question is, doesn't thus the federal regulation preempt state law? And I think you would agree that it would.
No, I would not, reclaiming my time. If the federal law requires me to wear a belt and the state law requires me to wear suspenders, I will comply with both laws. If you take the position that the state legislators are in the position to provide consumer protection, then you should repeal Dodd-Frank, as I'm sure, or at least these provisions of Dodd-Frank, as I'm sure has some support on your side of the aisle. When we passed the law establishing the CFPB, we decided that in addition to following state law, which might provide a 2-day period, there will also be an additional federal law. Now, you can say that a state that decides to have no regulation in a financial area has made a conscious decision that that is the best policy for that state. But we passed a federal law to say that there will be standards. Preempt is when you tell a company they don't have to comply with state law. Supplement is when you say you have to comply with the state law, plus you must comply with the federal law. Mr. Caudray, thank you for all you do. Part of what you do is coming here to Congress so that we can comment on what you do and perhaps help you do an even better job.
I think I just learned from you a little bit, so I appreciate that.
Okay. Now, as to Mr. Stiver's letter, there are some who say that that letter signed by many of us, and I want to say I signed the letter, and I'm a step ahead of you. I've read the letter. It does cite Code Section 1022B3 and quotes it accurately. And some have said, well, therefore, it's in favor of exempting some of the smaller institutions. So toddlers wouldn't be wearing shirts at all. But in fact, what it calls for is look at each regulation, determine whether you can have a one-size-fits-all regulation. I buy hats and one-size-fits-all, or shirts need to be tailored to the right size.
Yeah.
And the only ask in the letter is to be sure that your regulations don't have unintended consequences. And the specific focus is that when you write a regulation and you would want a different regulation or a different approach for smaller institutions, that you have a portion of the regulation applicable to smaller institutions.
That's sound advice, and it's something we will continue to try to heed, yes.
And there may be individual circumstances where we bring to your attention.
And we'll be glad to
that
take
regulation.
input on that in particular issues, yep.
We talked a couple days ago, you've urged financial institutions to use text messages, and thank you for saying you'll go to the FCC and make sure that the FCC will allow financial institutions to use text messages. If I can get a text message from my bank telling me I'm about to overdraft my account, I'll pay my phone company a nickel to get that information. I want to focus on TRID. These are complicated regulations. They're particularly complicated for smaller financial institutions. I want to commend you for having the hold harmless period. And institutions would like to get more written guidance as to how to apply the regs and what remediation steps they should take when remediation is necessary. We've talked about the hold harmless period continuing, and I think you should continue the hold harmless period at least until you can issue the interpretations necessary to provide written guidance.
That may go on forever, but we'll continue to be very attentive to the industry, and we've encouraged them to bring us their prioritized
at least
items
as long as it takes to to answer the questions that have emerged in the in the first 4 months. Obviously, some new question could come up. And finally, as we've talked, the regulations require an inaccurate statement as to the cost of title insurance in those states like California, where there's a buyer's policy and a owner's policy, and you get a discount on the owner's policy when you get the lender's policy. To correct the record, there's a lender's policy and there's a buyer's policy.
I was actually reminded I gave you an extra 30 seconds, so you got 14 to...
Oh. Thank you.
Go to town.
So in any case, Mr. Codray, you will be looking to make sure that the regulations deal with the situation where there's a stated price for the policy the buyer of the home is going to pay for, but there's an automatic discount that what's disclosed is the net price that the
I know that's
buyer
an
will
issue
pay.
that's been under active consideration during the rulemaking process and I believe since.
The time of the gentleman has now expired. The chair now recognizes the gentleman from Georgia, Mr. Westmoreland.
Thank you, Chairman. Director Cordray, on data security, what system do you use to determine if somebody is fulfilling their commitment on data security?
There's a number of procedures that have been developed and actually really enhanced in the federal government over the last several years. You know, the federal government's had some problems in this area, and the private sector's had many problems in this area, and it's something that I think we're all very attentive to. Nothing would more discredit.
What standard do you use if you're going to go out and evaluate a company and possibly fine them for having the...
I see. I thought you were talking about our own data security. We're using the standards that we understand to be common in the industry. We're using the standards of best practices at different institutions.
What standard would that be?
Well, we're taking some guidance from the Federal Trade Commission, which is ahead of us on this issue. We just had an enforcement action against Dwolla in this area.
What did you use for that enforcement? What
So-
standard did you use?
So
for
what
that?
we did was we do, whenever we engage in an enforcement matter, we open an investigation, took a look at their own security protocols, whether they were being followed. By the way, that's first thing. Whatever security level or threshold you're talking about, one is whether it's there on paper but actually being followed. If it's not being followed, then you have a problem. And that's one of the things that we thought we
But
found.
what standard do you use for the CFPB?
Again, we are looking at all of the standards in the industry and attempting to adapt from that. I don't, if you want me to have
So
my-
you don't have a standard now?
If you want me to have my staff follow up with you on some
Well,
of the
I'd just like to
details
know
of
what
that,
standard you're using,
okay,
because-
I'm not myself an expert in that area,
Okay.
but we could certainly inform you better, I'm
Well,
sure.
you stated that consumers entrust companies with significant amounts of sensitive personal information. And it's crucial that companies put systems in place that protect this information.
Mm-hmm.
I'm assuming you think it's just as critical for the CFPB to protect this information that, in your statement, you said consumers entrust with companies, but the CFPB has a lot of information that the consumer wouldn't normally give to a credit agency. Is that true?
Well, I'd say two things about that. Number one, I do think it's fair to hold us accountable for the security of data that we have. But number two, the data that we have typically is anonymized, and it is de-identified, and it cannot identify either you or me. So it is less risky than the kind of data you're talking about private companies having, which tells all about you and all about me, and it's very clear who's being identified there. That's much more risky, and if they get my credit card information or yours, we can be defrauded.
So you
We
think
can have our
private
accounts-
companies is much more, the information is much more risky than yours?
It's more risky because it's personally identified there, and that's typical. They're using it to market to you and
Okay.
me. Our data is not of that kind.
Who has tested your data security system? What company has tested it?
So the folks in the federal government who deal with this across all agencies set standards, and they've now enhanced the standards and improved the standards that we're all seeking to meet. And I think we're all trying to keep up with the best
I
practices.
know that, but who tested your security of your data?
So again, our IT group could come and give your office a briefing if you want to know the details.
Well, I know, I just
about
want to
that.
know who tested it, because, you know, you mentioned all the information that's available to other people and that you don't have that much information. I just want to give you a little rundown.
No, I said we have a different kind of information. We don't have
Okay.
information that's identified by you or by me. It is anonymized information for the most
Okay,
part.
I just know that in your system, you have the borrower or co-borrower's information of the name, address, zip code, telephone numbers, date of birth, race, ethnicity, gender, language, religion, Social Security, education, military, employment records, financial account numbers, financial events in the last few years, life events in the last few years, mortgage information, current balance, current monthly payment, delinquency grid, monthly payment, refinanced amount, bankruptcy information, credit card, account numbers, credit amount, loan balances, past due amount, minimum payment requirements, high balance amount, charge-off amount, second mortgages, household composition, single male, single female, presence of children by various age categories, number of wage earners in household, household income, property attributes, number of bedrooms, bathrooms, square footage, lot size, year built, age of structure, units in the structure, most recently assessed value, longitude, latitude, census block tract, date purchased, origination date, acquisition. Do you think this is
I'm not
really?
sure. I'm not sure what data you're talking about. What particular data are we
This
talking about?
data is given to you and is supposedly in your records. That's from
what
the
are we
National
talking about, the
Mortgage
mortgage
Database.
market? We talking about credit card market? What are you talking about here?
It's data that's in your system, and I think that we need to know how it has been protected.
Be glad to have my folks follow up with
The
yours
time
and
of the
give
gentleman
you more
has
satisfaction
expired.
on
The
that
chair
front.
wishes to advise all members that votes are expected somewhere between 1 and 1:20. I expect to clear the members in order in the queue and we will adjourn once votes are roughly 5 minutes out. We will not ask our witness to come back, but instead we will adjourn at that time. Chair now recognizes the gentleman from Illinois, Mr. Holgren.
Thank you, Mr. Chairman. Director Cordray, as you know, the committee has at length raised concerns with the guidance the Bureau issued in 2013, which it dubiously claimed is a simple interpretation of its authority under ECOA, despite explicit language and intent in Dodd-Frank to exclude automotive lending from the Bureau purview. We've also taken issue with the disparate impact theory and the questionable methodology used by the CFPB to administer it. This is also a major concern for my automobile dealers in my district and also all across Illinois. You've now relied on disparate impact theory of discrimination under ECOA in at least 3 separate enforcement actions against businesses that underwrite auto loans. I suspect that what you're doing is extending the Supreme Court's holding in the Inclusive Communities case, but that case dealt with the Fair Housing Act, not ECOA, and that decision rested primarily on the unique congressional history of FHA, history that is plainly inapplicable to ECOA. Wondering if you could spell out in detail the specific legal basis on which the CFPB is pursuing ECOA enforcement actions using disparate impact.
So I believe there was a considerable hope among a lot of the industry that disparate impact would be disapproved by the Supreme Court. And by the way, I understand interesting news, we have a new Supreme Court nominee this morning. And that was a challenge that was raised in the Inclusive Communities case that you referenced. And in fact, the Supreme Court resoundingly upheld disparate
That was an FHA case, right?
That is correct.
This is an ECOA case, right?
Yes. But
very different, very...
No, I don't think so.
No, it's very different.
I don't think so.
very specific.
I
requirements that we've got there were laid out, housing, fair housing.
Look,
but you're, I think, extrapolating something that we just can't find any rationale for.
2 laws have been applied hand in glove for decades.
ECOA specifically had exemptions for this, and yet you were using that.
Market, and they work together in the same
transaction. The sense that we have is you're just pulling this out of nothing because there's an agenda that's being pushed.
That's look, again,
let me
if
move on.
that had been upset, we wouldn't be enforcing the law.
We've talked a little bit about HMDA, and I want to ask you specifically about some concerns, privacy concerns. My colleague from Georgia, Mr. Westmoreland, raised some issues of the amount of data that you already have, specific data on individuals, and all of us have concerns. The federal government, I think, showing incredible weakness of being able to protect the privacy of our citizens. I hear it all the time from them. The recently finalized HMDA rule is especially concerning to me because it looks like it's not enough. All the information that Mr. Westmoreland had listed off, item after item after item, and now it looks like CFPB is looking for more of private information that I question if it's safe. Section 1094 of the Dodd-Frank Act, which made changes to HMDA, also required the Bureau to develop regulations that, and I quote, modify or require modification of itemized information for the purpose of protecting the privacy interests of the mortgage applications or mortgagors that is or will be available to the public, end quote. In a footnote to the final HMDA rule in October 2015, the Bureau states, and I quote, based on its analysis to date, the Bureau believes that some of the proposed new data points may create privacy concerns sufficient to warrant some degree of modification, including redaction before public disclosure, end quote. However, the Bureau is only providing opportunity to comment on the balancing test for consumer privacy, not the actual data made public by FFIEC. In a 2005 speech, former Federal Reserve Board Senior Advisor Glenn Cantor raised concerns about HMDA privacy risks, noting, and I quote again, approximately 95% of loan records are unique, meaning loan amounts and census tracts can be attributed to a single person. With a cross-match to private lien transfer records, one can identify these individuals in 95% of the cases, end quote. Shouldn't the Bureau proceed with extreme caution before finalizing any policy that would direct FFIEC to publish additional consumer information, even if steps are taken to anonymize it?
So thank you for the question, and as you pointed out, and I think you should be pleased, we are approaching this issue of the privacy issues very sensitively, and we have engaged in a further notice and comment.
I'm not pleased, and my consumers are not pleased, my banks are not pleased because they've seen breach after breach after breach by the federal government. Mr. Westmoreland asked, who's the company that's looking at it? You said there isn't one, basically. It's internal.
No,
We've
that's
seen
not what I
failures
said.
over and over again. And now
said I'd
my
be happy to
concern with
brief
HMDA
his
is you're
staff
going to be
and
getting
happy to
more
brief your
information.
staff,
It's stated by people in the administration saying that this does identify people, that 95% chances you're looking through this, we can know exactly who it is, even if it's anonymized. I don't think it's enough. My citizens are concerned, and now you're adding more requirement of getting more private information of my citizens. I think it's wrong. I think you ought to, all of us ought to proceed with extreme caution. To me, the least you could say is, yes, we will proceed with extreme caution. I yield
we
back.
will proceed
Time of the
very carefully in this
gentleman
area.
has expired.
Yes.
The chair now recognizes the gentleman from Colorado, Mr. Perlmutter, 5 minutes.
Thanks, Mr. Chairman. Mr. Cordray, thank you for being here. Thanks for your service to the United States of America. Thanks to the people that you lead in the agency. And, you know, as I've said to you many times, being a regulator, you're never anybody's best friend. And that's not your job, and that's not what you're supposed to be. But you're supposed to be looking out for the best interests of the people within the jurisdiction of your agency. And I thank you for doing that in so many different ways. You and I have disagreed on auto lending issues and auto dealership issues from time to time, but in a civilized, I think, in a respectful way. I was very disappointed to learn the other day about the deposition taken of one of your staff, one of your lead staff. I don't think that was appropriate, and I wanted to say that for the record. I mean, that kind of thing can happen in court if it needs to be, depositions under the oversight of a judge. Okay, that's how our system works. I would, and I'm just saying this, you take it or leave it as you choose, that I would hope that the agency keeps a dialogue open with the auto dealer industry in the hopes that there is some kind of common ground that can be reached without them continuing to pursue a legislative approach, but that there actually be some kind of something that is valuable for consumers, does our best to root out discrimination, respects due process. Good luck. I just ask you to keep the line of
All right, I appreciate that. And
communication
of course, we had difficulty initially because we tried hard not to be reaching out to auto dealers to be respectful of our jurisdictional lines. We came to learn eventually they were interested in talking to us. They continue to be interested in talking to us on various issues, and we therefore have been willing to respond to them in kind.
And I thank you for that, and I would like you, I just ask that you keep the lines of communication open to see
right.
if there is some kind of resolution short of legislation or lawsuits all the time. Okay. And I just want to thank you for all the other things that you've been working on, whether it's mortgages or credit cards or the like, because we, the Congress, in Dodd-Frank, and I know many of my friends on the Republican side, they don't like a lot of the provisions in Dodd-Frank, and okay, fine. But we had a lot of problems going into the 2008 collapse of the financial sector, and a lot of it had to do with respect to consumer lending and consumer matters. And that's obviously the mission of the agency, to deal with those kinds of things. So I didn't have anything specific I wanted to ask you. If you have anything you'd like to talk about.
Yeah, there was a point made earlier that I think is inaccurate and misguided, that somehow our rules have pushed the mortgage marketplace into the GSEs. The reality is that the irresponsible lending that precipitated the crisis and blew up the mortgage market and blew up the economy pushed most lending now to GSEs and destroyed the secondary financing market, which has not yet recovered. All of that preceded any of our rules, which didn't even take effect until 5 years after that. So again, just to set the record straight, there have been various statements today that I thought were not consistent with the facts, and I'll do my best to try to set the record straight where I can.
Well, and actually the record is more stark than you've just stated, that in 2008, 9, 10, the only entities buying loans in the secondary market were Fannie Mae and Freddie Mac. There was no secondary market. Okay, so I mean, everybody can, you know, go into their rhetoric and their
That's right. It
hyperbole.
blew up. It just destroyed itself through very irresponsible behavior. And by the way, another comment I saw the other day was that the Federal Reserve had kept interest rates too low leading into the housing crisis. And as I looked back at it, the interest rates were between 4% and 5% during that period. I'm not sure how high people wanted them to be, but again, the timing on that is not accurate to the facts.
The last thing I'd say, and just to remind everybody, you are an agency of the federal government. You have a lot of power, and however you exercise that power, we all expect you to do it judiciously. I think you've done that, but it's always something that has to be in the forefront of the minds of you and your members of your agency.
Yes, and
Time of the
power
gentleman
conferred on
has
us by
expired. The
Congress.
chair now recognizes the gentleman from
Chair, I yield back.
Pennsylvania, Mr. Fitzpatrick, Chairman of the Terrorism Finance Task Force.
Thank the Chairman, Mr. Director, over here on the right. I just want to follow up on the issue raised by my friend, Mr. Perlmutter, on indirect auto lending. Mr. Director, would you acknowledge that some borrowers, customers in the indirect auto lending area who have good credit have ended up paying higher interest rates and higher fees as a result of the approach of the CFPB and the enforcement actions that you brought? Is that possible that people with good credit who otherwise would have had a lower rate, lower costs,
what I know our
those costs have been
investigation,
increased?
what I know our investigations found was that there were many people with good credit who belonged to different minority groups who were being charged more for their loans
But
than
we're some
white
individuals
borrowers.
of any racial or ethnic background who have good credit. Did they pay higher rates and higher fees as a result of the approach and the enforcement action? Is that possible?
I've heard different views about that.
But it's possible. You would acknowledge it's possible?
I've heard different views about that. It depends in part on what the response to
Based on what you've heard,
enforcement
is it
actions
likely
are.
that that has happened?
I wouldn't say that.
You think it probably has not happened?
I just wouldn't say whether it's likely or not. I just, you know, it depends very much on the individual responses of individual lenders.
Mr. Director, I want to get into an area. I had some very small community banks that I visited with yesterday, and they're from Bucks County, Pennsylvania, and it has to do with the subject of overdraft fees. There are a lot of us that have concern that the rulemaking of your bureau is limiting the ability of small community banks to serve their customers and to provide real choices to their customers. And those customers could be individuals, small business owners. And these are sometimes customers who would otherwise seek out riskier non-bank alternatives, which is what I think we all collectively want to see them avoid. In regards to the overdraft fees, and I'm told that you're looking at a rule and a rule is being formulated now on this issue at the Bureau, is that correct?
We're working on that, yes.
And when is that expected to be released?
I think we have said that the proposed rule, which will again be subject to considerable comment, I'm sure, in a public notice process, will be released this spring.
This spring. So this particular bank that I met with yesterday wanted me to posit to you, she suggested that I ask the CFPB whether you have any willingness to de-identify data, which is something you were just talking with Mr. Westmoreland about, and release it to the public so that banks and financial institutions can interpret the data for themselves and can draw their own conclusions. Is that something you'd be willing to do?
What kind of data are we talking about? For what purpose? What do we...
The data that you're using to formulate the rule on overdraft fees.
I'm sorry, on small dollar loans or on overdraft?
On any of it.
I thought you were talking about small dollar loans when I said we were going to release a proposal this spring. On overdraft, we are not releasing a proposal this spring.
Would you be willing to release more of the underlying data that forms the basis of your conclusions?
So we issued a couple of different white papers on overdraft, if that's what you want me to address. Yes?
What I'd like you to address is the CFPB willing to release more information? I've introduced a bill called the Bureau Research Transparency Act, H.R. 3131. Are you familiar with that bill?
Not particularly, no.
What the bill would do is it would require the Bureau, when you make a report or a recommendation or you issue a rule, that you release the underlying data, which many times is not released. So that, as I said in my first question, so that banks can form their own conclusions.
Yeah. So let me speak to...
So are you willing to release more of the data that
Let me speak to circumstances where underlying data is not released, because our orientation and our inclination is to release as much data publicly as we can, because we want people to be able to do their own analyses, draw their own conclusions. For example, that's why we have the public complaint database. But some of the information we get is trade secret protected. So although one institution might want to know more about it, another institution might feel affected or grieved or disadvantaged.
This is
if
my
it's
question,
released.
Mr. Director. If it's
And-
de-identified and if it doesn't fall within one of your exceptions, and I'd like to hear about those exceptions like trade
Mhm.
secret, are you willing to release all the data that underlies your
Okay,
reports?
so again-
So that the reports are transparent, so that banks and financial institutions can, and the public can draw their own conclusions?
Yeah, it isn't just whether it's de-identified. It could contain confidential trade secret information. It may have been obtained in such a way, maybe we had to buy it from some provider in which there were conditions that we weren't able to negotiate away. It may be it was obtained through confidential supervisory information from a particular institution, which would be compromised if it were.
Mr. Director,
put
my
forward.
time is expired. Would you be willing to just lay out all of the exceptions to transparency on releasing the data that you were going to give us today? Can you give us that information in writing?
I think I just kind of verbally laid out
You just
much
did.
of it.
Those are all the exceptions.
There may be others, but I think that's.
If there are others,
that's
please
significant.
provide it in writing to me. Would you be willing
I'd be
to do
happy.
that?
So if you're interested in this area, I'd be happy to have our staff brief your staff and hear from them about what they'd like to know.
Thank you, Mr.
Time of the gentleman has expired. Chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Director Cordray, your agency has been under attack since its first day. I actually have I have something that I'd like to post on the screen right now, if I can. Powerful interests have opposed the agency's every move. Many call for the abolition of your agency, and I have a slide up there right now. On the screen is an ad run by a secret group called Protect America's Consumers. I have no idea who's running these ads on MSNBC in DC. I have no idea who's paying for them. We've seen some addresses that lead us to conclude that they might be very, very powerful interests, but we haven't received the confirmation yet. I was also angry at the deception in this ad and being quoted out of context by this front group that I made my own YouTube video. So not all opponents of the work of the CFPB, Not everyone is an opponent of the work of the CFPB. In fact, I want to congratulate the people here in the green shirts who are standing with the CFPB today. What you're doing is standing up for consumer justice, and I think that's really excellent. So I don't know if was I planning on running my thing? Okay, so this is my video setting the record straight that I have at all times support the CFPB, quite contrary to what the deceptive Protect Consumers ad implied. And also, you may have heard in a public speech that was given by our chairman yesterday on his vision financial markets. I'd like to ask you some questions about some ideas that were raised. For example, do CFPB rules requiring lenders provide closing cost documents to home buyers 3 days before they buy their house count as regulatory waterboarding of community bankers?
I wouldn't describe them that way, no.
Do you think that limiting forced arbitration in consumer and financial contracts is a monument to arrogance and the hubris of man?
I understand us to be trying to implement authority and direction given us by Congress.
And, you know, when we limit interest rates on small dollar loans to 36% for service members or act to prohibit lenders for charging African Americans higher rates of interest for car loans, is that creating an incomprehensible complexity of government control?
I think Congress legislated that to protect service members against being exploited while they're trying to protect and defend our country. I think it's quite appropriate, but again, that was a congressional judgment.
It's a strange place to be against service members, anyway. When the CFPB requires lenders to tell buyers of manufactured homes that the loans they're being offered are more expensive compared to other options in the market, is that an example of an unaccountable, arrogant bureaucracy dragging us toward the failed economy of a European-style social democracy? You don't need to answer.
Well, I will. I think we're just trying to put consumers in a position so they can make choices that they won't regret later, so that they can know what they really would want to know at the time.
It's
And
fair to-
that empowers consumers and promotes personal liberty.
It's fair to say that we don't all agree on this committee about the role of the CFPB, but I will say this, $11 billion turned back into the economy in the hands of ordinary working people, pretty good. On the screen is a recent monthly report of consumer complaints about financial products made to your agency. Many experts decried the financialization of the economy. They note that overcharges, hidden commissions, arbitration contracts, and cost millions in wealth to ordinary Americans. And yet, one of the quotes in the chairman's public speech was quoting Kanye West's statement that the only true freedom is economic freedom. Would you say that ensuring a fair financial marketplace actually furthers economic freedom for American people? Do people have more wealth now than some of these costly schemes are stopped? What do you think?
I think that enforcing the law fairly promotes economic freedom. It helps the free market work against a backdrop of law and order and law enforcement. And I think that this Bureau has proven itself to be not only pro-consumer protection, but also pro-consumers and pro-consumer opportunity. That's certainly how I see things.
And I would say being pro-consumer is being pro-business, and I'll tell you why. If you are an honest business person trying to give a good product at a fair price, you're competing against unscrupulous competitors, and they can beat you out, and that hurts the marketplace. It doesn't help it. I will yield back to the chairman.
Happened in the mortgage.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Chairman. Mr. Cordray, you and I have discussed this before, and I'd like to bring it up again. I, too, was in the Florida legislature. I, too, have some experience in dealing with payday loans. We had a terrible problem in Florida. We addressed that back in the early 2000s. We came out with a bill that I think has done a great deal of good to eliminate the predatory lending, the bad actors, and in fact, make sure that the transaction has a duration of between 7 to 31 days, cannot be greater than $500, and processing fee of no more than $5. There's a cooling off period of 24 hours. We have been able to, in the state of Florida, under our regulatory scheme, reduce the use of online loans, which we don't want to see our consumers go to. That would eliminate any regulatory control whatsoever. But we've been able to reduce it by 82% since then. Would you not agree that Florida, by far, is the gold standard when it comes to state regulation of payday loans?
I would not.
Why not? There's somebody else, there's another state out there better?
What I would say is I believe...
But is there a state out there better? There isn't, is there? And that's my point, Mr. Cordray, because
Sorry,
you see,
do you want me to answer the question?
yeah, is there another state that has a better track record than
So what I would
Florida?
say is there's been analysis done of the Florida model, and what it shows is these loans are still being made at above a 300% rate of interest, and they're being rolled over an average
and there's
of
no
9
state better, though,
times
but
for many
let me ask you this.
consumers.
Again, you're going to try to eliminate the demand thinking, eliminate the supply thinking you're going to eliminate the demand, which you're not. But let's take your statistics up there. We have your monthly report on payday loans. In fact, my colleague just before me had it up there, and it shows that since its inception, I believe that payday loans have had complaints registered with your office of 1.5% since 2011 have been complaints of payday loans. Now, that's not a significant thing, but when you think that 10 times that have been credit reporting agencies and you're not doing anything about that, why are we focusing on an industry that has a need in the market? Now,
So
let's
I
go back to
appreciate
Florida
that.
again.
I appreciate the question. I'm glad to lay out an answer for you.
Go right ahead.
So, for example, what we find is when we look at debt, some of these complaints are simply misclassified. People think they're complaining about debt collection.
You're misclassifying them.
And-
You have the greatest resources of any
No,
agency
no, no, no,
out
no,
there that's
no, no.
unaccountable to
I'm
Congress.
saying that people are complaining about debt collection. What we find is the incidence of payday loan debt collection complaints is much higher than that for student
And
loans
let
or
me help
auto
you with the
loans.
state of Florida
So
again.
that needs to be counted in as well.
Realize they had over 8 million, or right at 8 million payday loans in the state of Florida last year. You know how many complaints they had registered with the Financial Services Regulatory?
Okay, so let's also look at debt collection
117.
complaints
You know how much
and
that
how
is a
many of them
percentage?
proceed from payday loans.
0.001%. My gosh, what relationship would be great if all you had is 0.001% of complaints? We'd have marriages everywhere if we had that. But
So
what
you're-
I'm suggesting
you're
to you,
sort of
sir, is
ignoring
you're
the
not
point I'm
using
making,
logic and
which
reason to
is-
dictate what is going to be a policy that's forthcoming in spring. Sunday is spring. So
Yeah.
I anticipate there's going to be a report come this spring, right? After Sunday, can you give us a little trailer on it? Tell us what it's going to say about the payday loan industry. Tell us how we're going to eliminate all the state regulatory environments so that you have a company out there known as
self-help credit union that's kind of assisting you because they want to take over this market. Are you familiar with self-help credit union?
I have no idea what you're talking
You
about.
don't know
I've heard
about
that
self-help credit
allegation
union?
before, but some
Let me ask you this.
suggestion that they're trying to take over this market is sort of beyond.
Yes or no? Are you familiar with the Center for
fiction.
Responsible Lending?
Beg your pardon?
Are you familiar with the Center for Responsible Lending?
Yes, I'm familiar with
And they've had some impact in trying to allow their opinion or influence in promulgating the rule that you're going to.
Many stakeholders have had impact.
Are you
on
also
us.
familiar with their subsidiary?
I'm sorry?
Self-Help Credit Union, their subsidiary? Are you
What
familiar with them?
I'm not understanding is
You
this
know Self-Help
argument
Credit Union.
that's,
Have you
that's-
ever heard of Self-Help Credit Union? Yes or no?
I have, yes.
And do you know that they're a subsidiary of the Center for Responsible Lending?
I'm not familiar with the corporate relationship.
Have you had any relationships, any discussions, any emails, any communications with Self-Help Credit Union?
I have discussions with many stakeholders.
With Self-Help
we
Credit
have a payday lending
This is your
executive on our
opportunity to
consumer
clear anything
advisory
in the
board.
record.
So-
Self-Help Credit Union, any discussions, communications, directions, anything with them whatsoever?
Okay. So
Yes or no?
what I don't
Yes or
understand
no?
is this claim that somehow this is
It's not a
gonna
claim,
lead
it's a
to
question.
somebody
Yes
taking
or no?
over
Do
the
you have any
marketplace. I don't
communications,
see what
any-
the basis for that is.
So you can't say that you have. So would it surprise you that you have?
But I'm sorry.
Would
What
it
are we?
surprise you that you've
What's
had
the
any
question?
communications with Self-Help?
What's the question?
Self-Help Credit Union. Have you had any communications with them in any way, shape, or form?
I don't know whether I have or haven't, what you're talking about exactly.
Okay, well, you don't know whether you've had communications with them.
Look,
is what I'm asking you.
I'm sure I have. I've had communications with probably everybody who's had an interest in our rules going back for
Okay,
5
then
years
Can you give
now.
me, in 18 seconds or less, a little anticipation of what we may see in the rule you're going to promulgate this spring with regard to short-term loans?
Okay, so first of all, we haven't promulgated it yet, so nothing should be taken
That's-
to the bank.
Okay.
But I think you can take a lot out of our white paper and the small business review framework we provided, which is that we are going to seek to eliminate and limit predatory practices by lenders that embroil many consumers in a debt trap with consistent and prolonged rollover of
Time of the gentleman has expired. The chair
That is
now
harmful to
recognizes the gentleman
consumers.
from North Carolina, Mr. Pittenger.
Director Cordray, you have on a number of occasions touted the transparency of your agency, the Consumer Financial Protection Bureau. Is that correct?
Say that again?
You've touted the transparency of your agency. Is that correct?
Yes, by the way, I'd love to see some more transparency
Good.
on that
Thank you,
group
sir.
called
That's my
Protecting
question
America's
there.
Consumers and some attention to that.
Taking my time back, sir.
Okay.
Let's be respectful.
All right.
Mr. Cordray, in that light, you've also admitted that you and 12 of your directors have used private emails for official business. Is that not correct?
I think that's been a very limited
No,
practice.
sir. Have you used them or not?
A very limited practice.
sir, then you have used them.
in days where
How does the
our
American, Mr.
technology-
Cordray, how does the American public have any confidence in the records and the information that's captured, recorded, if you're using private email?
Okay, so first of all,
Mr. Cordray, do you approve of what Secretary Clinton did with her private emails?
I'm not familiar with those situations.
You're not familiar with that?
Yeah, I'm not.
That's very interesting that you're not
I haven't
familiar
been
with-
part of any of that, and I don't
Do you,
really know what to tell
do you believe that the public gets a proper accountability when you're using your private emails? Do you feel like the public is getting all the information that they deserve to have?
I know that there are policies that we have in place to make sure that government work is being captured in government databases, and that's.
Will you turn over to the committee all these private emails?
I don't really know what you're talking about. I'd be glad to have our staff work with your staff to try to understand your concerns.
We would
and
like
see
to
what
have a
that is.
full understanding of what has been conveyed over private emails regarding official business. It's just that clear.
Well, I'd be glad to follow up with you.
Thank you, sir. We will. Regarding your structure in the CFPB, you are the single director. Do you believe that it would be more prudent and more acceptable to have perhaps a 5-member bipartisan commission?
I've seen different approaches to different organizations. In state government, it's quite common to have a single
Do you think that you could gain more wisdom
individual.
from colleagues?
I'm sorry?
Do you think that you could gain wisdom from individuals who would join with you on such a
I do every day. I have a leadership group at
Well,
the
let's-
Bureau, and every organization
Let's talk
does.
about your time in the General Assembly in Ohio. You said you served on the General Assembly, and as such, I'm sure you served on committee, correct? Do you feel like that the public would be best served if that committee chair just issued his decision without
the full support of those who are on the committee and aware of all those issues. He didn't act alone, did he, sir?
Some committee chairs did, and some committee chairs didn't. So.
Well, he had accountability, didn't he?
Sure, and as an individual member, I had the ability to sponsor and introduce a bill if I wished to do so. I didn't have to ask anybody's permission.
But you're accountable to nobody, are you, Director Cordray?
Well, I'm accountable in the same way you are. I'm accountable ultimately to the public for the substantive actions that I take.
You've already stated that you don't act in full transparency.
No, I didn't say that.
You don't have a board that you're
I don't
accountable
agree with
to.
that.
You can't be fired without some egregious abuse.
Look, my role in the federal government is a role that was established by Congress. The conditions were set by Congress. I didn't get to just write them up the
And
way
I think
pleased.
that's our point. I think we would like to hear your wisdom and what you believe would be the best accountability for the American people.
Okay,
Do you think it would be in the best interest of the American people that we had a 5-commission bipartisan board?
So one of the things I think is that when I come here and testify in front of you, you can call me to account. There's nobody I can blame it on. There's
You
nobody I
spend
can
3
say,
hours
well,
with us,
somebody else might
and then
think
you leave for
differently.
6 months.
I'm
and come
accountable
back.
directly to you.
These are difficult hours, I know, for you. You don't enjoy them because you're having to be accountable.
No, these are
And
not
when you leave
difficult.
this room, that
I
you're
actually
not-
enjoy
you don't have to
coming
be
before the
accountable
committee.
again.
I enjoy coming before the committee. And when I was a single official in charge of the Ohio Attorney General's office or the Ohio Treasurer's office, I was also accountable. I always have felt that I'm accountable in public service, ultimately to the public, to serve them well. And I appreciate the oversight of this body. That I come here not only when I'm required, but other times when I'm invited. And I've never ducked or dodged, and I've always been willing to stay as long as you want me to stay.
I think
and
doctrine
I
dodging
continue
would
to do
mean that you're responsive when we contact you, when we write you, when we ask for information. There's been delay after delay in getting information from you on so many occasions.
I think
I'm
we
asking
have
now
always,
for the-
I've always read, we've always answered your letters. If the response is not sufficient, we're happy to follow up. We continue to do that. We will continue to do that. If there's anything that you think that we haven't sufficiently followed
You're your
up
own
on, let
man.
us know,
You
and
run
I
an
will come back.
agency, essentially, what, $600 million a year or more, accountable basically to nobody. You have no board that
No,
you're accountable to.
look, we have all kinds of accountability in our statute. Congress set the terms. Congress set the terms
I
for
just made the
special
case for
audits.
transparency.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Missouri, Ms. Wagner.
Thank you, Mr. Chairman. Wow. Never ducked or dodged.
Yep.
Answer all letters. All right, Director Corday, let's have a conversation. Our committee sent you a subpoena back in December asking for documents regarding a variety of issues as discrimination, such as discrimination and retaliation, auto lending, and others. And despite you saying the CFPB is committed to transparency and compliance, always answer our letters, never duck or dodge, you all have failed once again to respond adequately to this subpoena. Additionally, the committee sent this letter right here. I have a copy of it. I'll submit to the for the good of the order on how all of you are complying with the subpoena regarding the such terms that you all are using. Will you commit, Director Cordray, to providing this information to our committee here right now?
We continue to work with the committee.
Will you commit
and the subcommittee
to providing information and complying to the request of this subpoena from your office? Will you,
So
will you commit to that?
I'd be glad to know specifics from you.
If so, when?
I'd like to know specifics about how we have not complied. I know that in response to that, we have
You
set
have
up-
failed
we've set up-
to comply.
In what way?
That's the, you
Give me a
haven't
specific.
responded to the subpoena or to the letter.
Of course we've responded. We've produced another, I think, 20,000 pages of documents.
Not in any adequate way, shape,
Well, okay,
or form.
tell me how it's inadequate.
Will you submit, will you absolutely right now commit to complying with our committee? If so, when?
We have been working to comply all along. We will continue to
Working to
work
comply, Director Cordray, is what we call ducking and dodging. Let me move on. Director Cordray, last year I asked a question about who gave the authorization to renovate the leased headquarters of your agency. And I haven't forgotten the response you gave to me, which was, and I quote, "And why does it matter to you?" Well, Director, it still matters to me because that is government expenditure of $215 million of taxpayer money. Last year, you said that Treasury made the decision. However, the committee sent a letter to Treasury asking about it, and they said that you, the CFPB, made the decision Clearly, both of you can't be right, sir. You've
Okay,
had a
so-
year since that last time I've asked to look into this, and so who authorized the renovations, sir?
Okay, so first of all, this has been misstated and garbled, okay? I never said that, why would you look into an expenditure of funds? You're entitled to look into expenditure of funds, and I appreciate that oversight, and we have
You
given you...
said, why does it matter to you?
Yeah,
And it
but-
matters to the taxpayers.
but
It
the
certainly
it, the
deserves
it-
to the Missouri 2nd Congressional District people that I represent.
The it was not expenditure of public funds. The it was who signed off originally
Who
on
authorized it? I just simple question, who?
this. Okay, so
Because I've got more questions, sir. Who authorized it?
as I said to you, and I've said it to this committee numerous times, I later reaffirmed that decision, and I continue to stand behind the decision.
You know,
So in
Elizabeth
terms of
Warren,
who originally...
reclaiming my time because you're clearly not answering the question again. As you know, Elizabeth Warren was working at Treasury as a special advisor and was understood to be responsible for setting up the Bureau. She also published a blog post announcing that the CFPB headquarters would be located at 1700 G Street. So let me ask you, was it Elizabeth Warren who absolutely ordered and authorized the renovation, sir?
I don't know, it seems like that's what you're trying to get me to say.
I want the truth, sir.
Okay.
Who ordered a $215 million expenditure of renovations using the taxpayers' money?
So first of all, it's not $215 million. That's never been true. It's not accurate. We've corrected the record on that numerous times. Second, I have reaffirmed that decision, and I take responsibility and accountability for it.
So
I'm
you're saying
solely
that you
accountable
gave
to
the
you for it.
authorization for that?
So I was not in the position at the time.
All right, reclaiming my time.
And we did not have
Reclaiming my
authority
time, Mr.
separate
Cordray,
from
it is my
Treasury
time. It
at
is
the
really
time.
unbelievable that you don't know who authorized it and that you won't
No,
give
no,
a
that's
great answer
not,
to this.
that's not, look, the
Mr.
first,
Cordray,
the first year...
reclaiming my time, especially since you don't even own it, and you know that the building's been assessed at $150 million. It really makes me question how else the CFPB spends its money. Last month, Representative Barr, a great colleague of mine, questioned Chair Yellen on whether the Federal Reserve approves the CFPB's budget and whether the Fed is even able to veto specific funding requests. The answer to both of those questions was no.
Congress set up
So,
that
Director,
system.
I'm not finished, Director Cordray. So,
Okay.
Director Cordray, how exactly does this work? You simply send the Federal Reserve an invoice, and as long as it doesn't hit the caps that were set by Dodd-Frank, then it's approved automatically. How does this happen?
Okay. We're simply carrying out the law that Congress enacted. You and your colleagues in the Congress or those who preceded you enacted that law. We're carrying it out.
Time of the gentlelady has expired. Members are advised there are votes on the floor. 10 minutes left in the first vote. We anticipate clearing one more questioner. The gentleman from Kentucky, Mr. Barr, is recognized.
Thank you, Mr. Chairman. And Director Cordray, I'll just follow up from my colleague, Ms. Wagner, on that question regarding the source of the CFPB's funding. In your semi-annual report, you say that the director of the CFPB requests transfers from the Federal Reserve System in amounts that he has determined are reasonably necessary to carry out the Bureau's mission. What was the transfer requested in FY 2015?
I'd have to look at my...
What do you anticipate it being in FY 16?
So our published budget for FY 2016 is for $606 million.
Okay, and does the Fed approve that budget?
The budget has to be within the parameters set by
I understand it has
Congress.
to be below the cap. Does the Fed approve that budget?
Well, you mean particulars of
Yes.
the budget or the overall total of the budget?
Both. Total, particulars, anything?
I assume if we were seeking to obtain more than our cap, that would not be
But
permitted.
otherwise, the Fed doesn't approve the budget. Let me ask it this way. Does the Fed ever review?
That's correct.
Does the Fed ever, has the Fed, or does the Fed ever review the Bureau's transfer request?
I believe they do. We send transfer requests and they fulfill them.
Okay, and it's as simple as that. So to your knowledge, the Fed has never asked any questions about that transfer?
I don't deal with the details of the back and forth with the Fed, but
But to your knowledge, they've never asked any questions about that transfer request?
I wouldn't know what to say to that.
Well, let me ask the question this way. Has the Fed, to your knowledge, ever denied a particular transfer request?
All of our requests have been within the bounds of the law
And the Fed has
established
never
by Congress.
vetoed a particular allocation or a particular expenditure made by the Bureau?
Again, that's the system established by Congress, and we're carrying it out.
So the Fed is not involved in any way in the implementation of the Bureau's budget. That's the point. And to that point, that's our concern, frankly, because the fact that the Bureau has been able to move forward with a $215 million luxury renovations to its headquarters, spent $60 million on management consulting services, and pays the average Bureau employee more than members of Congress would support the conclusion that the Fed is merely a rubber stamp to your expenditures. And we would hope that since you're not accountable to the Congress, not subject to the congressional appropriations process, as you point out, by a statutory design in the Dodd-Frank law, a fundamental flaw in the Dodd-Frank law in my judgment, that we would hope that you would be at least accountable to the source of your funding.
So I think several of the things you just described are inaccurate, by the way, but happy to correct the record if you wish.
Let's switch gears really quickly and talk about the arbitration rulemaking that and the arbitration study that we asked about in that letter. Your response to our letter did not answer our questions about the deficiencies in the data. Did the study in any way confirm that arbitration can be faster than a class action lawsuit?
I think it would depend on the individual arbitration.
Was there any data that supported that arbitration can result in a faster, more expedited resolution for the consumer?
Sometimes a lawsuit can go faster, sometimes an arbitration
Was there
can
any
go
data
faster.
that arbitration can be less expensive for a consumer?
Again, depending on the matter, some cases that go to court would be less expensive, some cases that go to arbitration would be more expensive.
Okay, and so there is data to support that. Was there any data that it can be more effective way for consumers to resolve disputes?
I don't know what a more effective way to resolve.
Well, the point is
How are you
that
judging that?
the point is that you have said that you have a duty to enforce the law, the Dodd-Frank law, not the 1928 law enacted by statute. Well, here's what the Dodd-Frank law says. It says that the rule must be in the public interest for the protection of consumers and consistent with the study. My point is that your study shows that arbitration can sometimes, and in many cases, be in the best interest of the consumer in terms of a faster resolution, a better result for the consumer. And so I would encourage the Bureau to not move forward with a rule that is inconsistent with the benefits of arbitration. In preparing the study, did the Bureau coordinate with the American Association for Justice?
Beg your pardon?
Did the Bureau, in preparing the study, coordinate with the American Association for Justice?
I don't know who that is.
Well, that's the Trade Association for Class Action Lawyers. The reason I ask is because the Bureau cites a study by Professor Sovern that purports to analyze consumers' knowledge of whether their financial agreements contain an arbitration clause. Do you know how Professor Sovern's study was funded? Because it was funded by the American Association for Justice. That's a conflict of interest that you have. You're using data from a study that's funded by the class action plaintiffs bar.
Look, we took input from all stakeholders. There were also studies that have been funded by industry. I don't hear you complaining about the conflict of interest there.
Time
what
the
I would
gentleman
simply
has
say is
expired. I'll now recognize the ranking member for unanimous consent.
we'll carry out the
request.
statutory.
Unanimous consent to submit for the record a study from the Center for Responsible Lending Report, non-negotiable negotiations
Without
that have
objection.
African Americans
I
and
wanna
Latinos
thank the
on dealer
witness
finance
for
car loans.
his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which we forwarded to the witness for his response. I would ask you, Mr. Director, to respond promptly and accurately as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.